Today we have a two-day conference as well, in which we are covering the domestic as well as the global taxation. I will now like to welcome Mr. Vineet Agarwal, who is currently the chairman of CII Western Region Tax Leaders Forum, and this is the second year he's chairing this forum. And he's also the senior executive vice president and group head taxation of the GSW group. Over to you, sir. So you are on mute. You are on mute.
Oh, sorry. Thank you. So, dear delegates, a very good morning to all of you. I welcome all of you to CII Western Region's annual two-day conference. Thank you for taking time out of and joining this very important relevant event, which encompasses relevant and contemporary issues in taxation canvas. I would like to take a few minutes to talk about Confederation of Indian Industry, CII. Originally started as a chamber of commerce, after its existence spanning more than 125 years, today CII is better known as a developmental institution and the first port of call for governments, not only in India, but worldwide, as far as business affairs in India are concerned. This is not surprising that CII's scope of engagement today encompasses not only the industry, but also the government and civil society. With 62 offices, including 10 centers of excellence in India, and 8 overseas offices in Australia, Egypt, Germany, Indonesia, Singapore, UAE, UK, and USA, as well as institutional partnership with 394 counterpart organizations in 133 countries, CII serves as a reference point for Indian industry and the international business community. CII is a non-government, not-for-profit, industry-led, and industry-managed organization with about 9,000 members from the private as well as public sectors, including SMEs and MNCs, and an indirect membership of over 3 lakh enterprises from 294 national and regional sectoral industry bodies. As India marches towards its 75th year of independence in 2022, CII has adopted the theme as Building India for a New World, Competitiveness, Growth, Sustainability, Technology for the year 2021-22. Rededicating itself to meeting the aspirations of citizens for a morally, economically, and technologically advanced country in partnership with government, industry, and all stakeholders. CII undertakes a multitude of initiatives for the industry, spanning across policy advocacy, knowledge building, training, and capacity building, and business development, among others. Taxation has been one of the very important areas of policy advocacy for CII. In addition to the members' recommendations for pre-budget memorandum, CII represents to the government a number of taxation-based issues faced by members. CII has also been organizing a variety of knowledge-based events to update industry on latest developments in taxation. At CII Western Region, we have a very active tax leaders forum, which has eminent tax heads from leading companies as members. The platform enables discussion on tax development, implications, and issues faced, if any. I urge tax heads present in today's conference to connect with CII Secretariat and explore this very useful forum. At CII Western Region, we have recently launched the Msme tax helpline, where our industry experts in both direct and indirect tax domain address queries from small businesses, even from interiors, absolutely free of cost. I call upon our MSMEs to take maximum advantage of this helpline. After the COVID-19 pandemic outbreak in 2020, economies across the world are resorting to imposing more taxes on businesses as governments aim for revenue generation. Simultaneously, world is come together to ensure a minimum tax on transnational organizations in a jurisdiction where the real economic activity is being undertaken. Imposing taxes on revenues generated in a country, as well as curbing tax evasion and aggressive tax avoidance planning is vital for development of a nation. However, stable and clearer tax provisions, supported with a neutral approach to tax administration in a fair and equitable manner, are equally important to improve investor sentiment towards doing business in India. Recently, we have seen various steps by government in this direction, be it faceless interaction with stakeholders in income tax, customs, and exim processes, rationalization in GST regime, spate of clarifications from GST Council, coupled with provisions like introduction of significant economic presence, which is called SEP, TDS on transactions on digital marketplace, etc. In our 2 days conference, we have bifurcated sessions into domestic taxation and cross-border taxation, wherein we shall hear from our experts about important provisions and also recent developments in this domain. We have some very interesting sessions encompassing TDS and TCS, tax consideration for internal reorganizations, GST audit, digital taxation, and OIDAR, FTAs, transfer pricing compliances, and developments on global taxation front. I hope these sessions will be useful to each one of you and you will have some interesting takeaways. I would like to thank NextDime for supporting this conference and all learned speakers who have taken time from their busy schedules to share their knowledge and experience with our participants. I wish you all a great time at CII Tax Conference. Thank you so much. Now I call upon Ms. Anita Varasur, partner, Direct Tax Sudeep K. Parikh and Company, LLP, to enlighten us on all of us on topics changing face of TDS, TCS compliances, industry and industry preparedness. Over to you, Ms. Varasur.
Thank you. Thank you, Vinitji. I'll just share my screen. I hope you can see my screen.
Yeah, we can see the screen. We can hear you.
Yeah, okay, thanks. Just a minute. Huh? Right. In order to ensure bandwidth issues, I will just put off my video. I hope that is okay.
Yes, that works. And I will also request participants to kindly type their questions that they have as the session happens, so you don't wait till the end of the session and the questions can be answered towards the end. So you may type in questions at any point in time. Thank you.
Right. Nena, I think there is an issue with the movement of the...
Okay, we will just upload it from here. No issues.
1 second. It's moving now, right?
No, we will upload it from our end. You can just, stop sharing it.
Thank you. So first of all, thank you very much to CII for giving me this opportunity to take the presentation. Today's topic is changing face of TDS and TCS compliances. Next slide, please. TDS TCS has been in existence for the past many decades. The basic purpose of these provisions is to ensure collection of taxes at the earliest and also see that there is no loss of revenue to the government. As we have seen over time, the authorities have been widening the scope of this collection and have been adding more and more transactions or expenses under the TDS net. In spite of the fact that assessees are discharging the responsibility of the government and enabling the authorities in collection of taxes, there are interest and penal provisions prescribed for delay and or non-compliance in addition to disallowance of the expenditure itself. Can you move to the next slide, please? Next. So withholding tax provisions become applicable on various transactions or payments, whether it is payment under employment, which would include salary, perquisites, withdrawal from PF, etc. It becomes applicable on gambling receipts, which would include winning from lottery and crossword puzzles, horse races, etc. Capital transactions also get covered under TDS, which is, it becomes applicable on maturity of insurance policies, transfer of immovable property, compulsory acquisition of land, and payment under joint development agreement. TDS, of course, is applicable on regular transactions, which are in the nature of contractual payments, professional fees, commission or brokerage, commission on insurance, income from units, and various other specified transactions. And last but not the least, it is applicable on passive income, which is interest, rent, withdrawal from NSS, etc. Next slide, please. To carry out the withholding tax compliances, one needs to have a tax deduction account number or a TAN. Post obtaining the TAN, the due taxes are to be withheld on a month-on-month basis and deposited into the government treasury within 7 days from the end of the relevant month. The law also requires filing of statement of taxes deducted and collected on a quarterly basis, and issuance of certificates in connection with these taxes that have been deducted. Next slide. Next. In the recent past, government has introduced withholding tax on dividend and mutual funds, cash withdrawals, e-commerce transactions, and purchase of goods. In addition, provisions of tax collection has been expanded to include a liberalized remittance scheme, tour packages, and sale of goods. In addition, the government has enlarged the scope of equalization levy as well. Initially in 2016, equalization levy was applicable only in case of advertisement, but now it covers e-commerce transactions as well. In order to penalize deductees who do not have a PAN and who have not filed their returns for the past 2 years, higher rate of tax is also prescribed. Next. I will take you through the recent provisions that have been introduced. TDS on dividend. In budget 2020, next slide please. In budget 2020, dividend distribution tax was abolished and provision of tax deduction on dividend payments was reintroduced. The amended provisions are applicable to all companies with no exceptions. As per these provisions, the company declaring dividend is required to withhold tax at prescribed rate, including granting of benefit under DTAA to non-resident shareholders. With the introduction of TDS on dividend, companies have been facing large challenges, huge challenges, due to voluminous data of the shareholders, limited time available for classification of shareholders, collation and verification of various documents for non-deduction, which is in the form of 15G, 15H, collation and collection of treaty documents, calculation of the correct rate of interest, issuance of certificates for remittance, and so on and so forth. Next slide. While giving the treaty benefits, companies need to look into not only the treaty provisions, but also the applicability of MLI, documents evidencing availability of treaty benefits, whether the treaty has any specific clauses like the MFN clause, etc. Next slide. There are also some issues which are faced by the companies where there is mismatch of PAN record or the PAN characters which are available with the RTA. And post 1st of July, where dividends are being declared, provisions of 206 AB, which is the higher rate of tax due to non-availability of PAN and non-filing of returns, become applicable. Next slide, please. The next provision is TDS and TCS on purchase and sale of goods. While budget 2020 introduced TCS on sale of goods effective from 1st of April 2020. Budget 2021 introduced TDS on purchase of goods effective 1st July 2021. Both the provisions are a mirror image of each other, barring a few exceptions. TDS, TCS on purchase or sale of goods is applicable at the rate of 0.1% of purchase or sale value of the goods exceeding INR 5 million. The provisions are applicable where transaction between buyer and seller exceeds 100 million during the previous financial year. In case of non-availability of PAN, TDS at the rate of 5% becomes applicable and TCS at the rate of 1% is applicable. Next slide, please. Various circulars have been issued and for clarifying the applicability of TDS, TCS provisions. These circulars clarify that TDS or TCS is not applicable on listed securities, thereby implying that it would be applicable on transactions in respect of unlisted security. The threshold limit of INR 5 million needs to be considered from the start of the year, irrespective from the time when the provision becomes applicable. GST is not required to be adjusted for purposes of TCS. However, in case of purchase, GST needs to be considered while determining tax to be withheld. Also, in case of advance payment, the tax needs to be collected on the entire advance because the GST component is not clearly identifiable or mentioned on the face of the invoice. In case of purchase return, no adjustment is required while determining the TCS. Whereas where in case of TDS, purchase return needs to be adjusted only in case of exchange of goods. In the event of refund, excess deduction of tax is to be adjusted against subsequent payments of the same party. There's also a clarification that TDS provisions are not applicable in the case of a non-resident not having a permanent establishment in India, companies in the first year of incorporation, exempt entities, provided their entire income is exempt. Next slide, please. While provisions impose primary responsibility on the buyer to withhold tax, circular clarifies that in case TCS has been collected by the seller, TDS provisions will not be applicable. Further, tax deduction under section 194(0) will take precedence over other provisions. In the event a buyer or seller is a non-filer or is considered as a specified person, the tax rate would be 5%. While TCS may no longer be required to be collected if taxes have been withheld, there is an additional burden on the seller where certain data needs to be disclosed in the returns to be filed. Next slide, please. Next slide. So this is a process flow which can be used for analyzing a transaction from the applicability of TDS or TCS. So first, one needs to check whether buyer's turnover in the preceding financial year exceeds 100 million or not. If it exceeds 100 million, one needs to see whether purchases from the vendor during the financial year exceeds 5 million. If it does not, no action needs to be taken. If it exceeds, then whether the vendor has a PAN and has filed the previous 2 years return on it. So in short, one needs to see whether the party is a specified party or not. If the party is not a specified party, then tax will have to be deducted at the rate of 0.1%. Otherwise, it is at the rate of 5%. Now, if the turnover of the buyer is less than, exceeds 100 million, then if it does not exceed 100 million, then one needs to check whether the seller's turnover is in the preceding financial year exceeds 100 million or not. One also needs to check the aggregate sales made to the buyer during the financial year, whether it exceeds 5 million or not, and whether the buyer has withheld tax or not. Next slide, please. While the circulars issued by the government have clarified a lot of open issues, some issues still continue. One is whether TDS, TCS provisions would be applicable in the case of slum sale. Also, certain entities, if we all recall, for financial year 2021, the government had given a relaxation in the rates of TDS and TCS. So if the TCS has been collected on the relaxed rates on accrual basis, then currently if the payment is received post 31st March 2021, the differential rate will have to be further collected. Another issue is whether the threshold limit of 5 million is to be considered inclusive of GST or exclusive of GST. Next slide, please. So the other provision is TDS on e-commerce transaction. The budget 2020 introduced this new provision where e-commerce operators are required to withhold taxes while making payment to the registered sellers or service providers. Taxes need to be withheld at the rate of 1% on the gross value of sales made by the registered sellers or service provider. The higher rate of 5% will be applicable in case of non-availability of PAN. TDS is applicable both on sale of goods as well as provision of services. Services will include professional services and fees for technical services as defined in section 194J. No deduction is required under any other provision where taxes have been withheld under these provisions. Next slide, please. In case gross value of sale of goods or services doesn't exceed 5 lakh rupees and registered service provider has furnished a PAN, again, no tax deduction is required. These provisions are applicable in addition to the equalization levy provisions if it is applicable on different taxpayers and on the same transaction. For the non-resident e-commerce operator has been prescribed to be person responsible for tax deduction under section 194O. Next slide, please. Next slide. Under these provisions also, there are certain open issues. One is regarding the applicability of provisions where payment for gross value of goods or services is received directly by the registered seller or service provider. Also, what is the fate of the adjustments of returns or cancellations, value on which TDS would be applicable in such an event? Next slide, please. So the government has also prescribed certain penal consequences. A taxpayer may have to face these severe consequences in the event of a failure to comply with the withholding tax provisions. This would include disallowance of the expenditure. The taxpayer would be treated as an assessee in default, but will still have to make good the taxes not withheld. There will be penalty for failure to deduct or collect tax. If the required lower deduction forms, Form 15G, 15H have not been submitted in time, there is a penalty prescribed for that as well. And as if this is not enough, there are prosecution provisions as well. Next slide, please. So what is the way forward? Corporate India needs to gear up to ensure completeness, timeliness, and accuracy in compliance, including taking the legal positions considering the facts and circumstances of the case. It may need to leverage technology, adopt automation internally, or take services of a technology firm. This, of course, will be in addition to the need to integrate accounting package or streamline the processes. It may also need to ensure that the taxes collected or deducted are reflected appropriately in the Form 26AS so as to ensure no loss of credit. So these are some of the things which one needs to take care of, keeping in mind the new provisions. Happy to answer questions if any.
I can already see some questions. One is, should I read it out for you?
Yes, please.
Okay, one of the questions is from Bhavik Mehta. Does one need to check the list of shareholders, whether shareholders are defaulters in section 206AB, 206CCA of higher rate of TDS while checking TDS on dividend under section 194?
So basically for TDS on dividend, it's going to be 206AB. Yes, one will need to look at the list of specified persons.
Okay, thank you very much. I will request participants to type in their questions. We have another one from Mr. Akshat Jain. The question is whether TDS under section 194Q is applicable on coal purchases which are covered under section 206C, but exempt white 206C1A.
Just have a look at the...
Hello?
Yeah. Let me just have a look at the provision, Naina.
Sure.
Naina, while I look at this, I think we can answer the other questions. I can come back to Akshat Jain, Naina.
Sure. I can see a couple of more questions over there.
Yeah.
So we go to the next. What is industry experience on TCS reporting compliance requirement?
So I'm not very clear on what the person is asking. Are they talking about reporting of parties where taxes have not been deducted or what? I'm not very clear.
So I am requesting the attendee to kindly clarify this because the name is not there. Next question is from Mr. Priyesh Bhatt, whether GST should be considered while calculating threshold of INR 50 lakhs.
Ideally, yes, it should be considered.
The next one is 2061H has specified limit of rupees 50 lakhs, whether this limit is for each buyer and each year, as section mentioned any previous year.
2061H has specified limit of 50 lakhs, whether this limit is for each buyer and each year. Yes, it is for each buyer and each year.
One more question we have from Mr. Ashok Subramaniam. For TCS, the definition of what constitutes government is not clear. A lot of government companies, institutions are not accepting TCS, claiming to be government. A representation needs to be made to CBDT to clarify on government customers. This is a major issue of pharma industry.
I think this is for CII.
Sure. I think that is it. We haven't received any more questions.
There are a few more questions that are there.
Yeah, I can see something that has come now. Yeah. Okay, we have a question from anonymous attendee. What is industry experience on TCS reporting? This is in terms of reporting TDS details collected from customer in TCS return.
Based on our experience, you know, it is happening quite smoothly.
Okay. The next question is from Pauravi Shah. In case a seller has charged TCS on a particular transaction and later the buyer realizes he is supposed to charge TDS, then there will be a non-compliance for buyer. Then will there be a non-compliance for buyer?
See, as far so the TDS provisions precede the TCS provisions. The law says if TCS has happened, then TDS is not required to be done. Right?
Okay.
Now, if TCS has preceded the applicability of the happening of the TDS, then in my view, it will not, there won't be any consequences. But if TDS has not been collected and then there is TCS, then there could be consequences on the deductor.
Okay. The next question is from Neeraj Katoch. Whether TCS under section 194Q will apply on electricity charges?
So 194Q is applicable in case of purchase of goods. So one needs to see whether electricity can be said to be goods.
Anita, may I answer this question?
Yes, please.
Yeah. So electricity is very much considered as a goods in previously by Supreme Court in so many cases. And if you recall, erstwhile excise duty also have one line item that the manufacturing of electricity, but rate was nil. So electricity is very much a goods, and accordingly 194Q is applicable. And we as a power company are collecting TCS.
Thank you, Sunilji. Thank you.
Okay. We have two more questions. If seller is following, this is from Mr. Priyesh Bhatt. If seller is following accrual method of accounting, still, then if they charge TCS on their invoice, can buyers still deduct TDS under 194Q? If yes, can there be double taxation on same invoice possible?
So, see, a number of corporates are following this practice of charging TCS in the invoice itself. But if you go by the provision of the law, it says TCS is required to be collected at the time of making the payment, right? And where TDS is concerned, the applicability is on payment or credit, whichever is earlier. So in my view, the TDS will prevail over TCS in spite of the fact that TCS forms part of the invoice.
Okay. The next question is factories on rent. Electricity bill is being paid by the company as per rent agreement. Bill is in name of owner who is liable for TDS. Is electricity distribution company supposed to collect TCS?
I'll need to come back on this, Nena.
Sure.
Anita, may I answer this question?
Yes, please.
Yeah. So far as electricity company is concerned, they are considering who is the customer. In their record, customer is the person, whether company or the owner, they will consider that whoever is using or making payment is not relevant. So in that case, company will consider if the owner is, if the customer to whom bill is raised is not liable to deduct TDS under section 194Q, electricity company will collect TCS. So far as user is concerned, is irrelevant.
Okay. Moving to the next question from Mr. Rishabh Sharma. In section 206C, 1H, if any resident company in India is selling shares of its subsidiary company in India to a non-resident foreign company, and 206C, 1H limits are applicable to such resident company, whether resident company is required to collect TCS on such payment received on sale of shares. The word sale of goods includes non-listed shares or not.
So sale of goods does not talk about non-listed shares. It is only if you look at the circular where they are talking about about security, they are talking about listed securities, and therefore one can say that in case of non-listed securities, TCS would apply.
Okay. We have two more questions. I think we can stop there because we already moving into the next panel timing. So the next question is from Ankit Zaveri, whether TDS on dividend is deductible when individual shareholder doesn't have PAN and dividend payable is less than 5,000.
So ideally, the TDS on dividend is applicable only where the dividend exceeds 5,000. So in my view, TDS will not apply.
Great. The last question is 2061H has specified limit of 50 lakhs, whether this limit is for each buyer and each year as section mentioned any previous year.
Yeah, it is for each buyer and each year.
Okay. Thank you so much, Ms. Basroor. It was a very interactive session. We will now move on to the next session, which is a panel discussion. The topic is tax consideration for internal reorganizations. May I now call upon Mr. Maulik Doshi, Deputy Managing Director, next time to take over the session. Thank you.
Thank you, Naina, and a very good morning to all our participants. It is really a pleasure to be a part of CII two-day conference, and I really look forward to an enriching panel discussion that we have today. The topic for the panel discussion is kind of very apt and very relevant in current times. Mergers, acquisitions, internal restructuring of businesses have always been an integral part of the corporate strategy. These strategies really help organizations to improve their growth prospects, their financial performance, and meet their core objectives. In the recent COVID-19 times, especially in the last couple of years that we have gone through the lockdown and the COVID-19 pandemic, this has actually forced organizations to really optimize their operations, and consolidation and internal reorganizations have been the buzzwords. Corporate restructuring would encompass a wide variety of modes and strategies. You've seen mergers, demergers, slump sale, hive-ops, sale purchases, capital reduction to extract cash, joint ventures, strategic alliances, somewhere even family settlements, or even entity rationalization plans, in the sense closing down the entities which are not really doing any business operations. Each of the restructuring plan would kind of entail that you look at the right strategy, sometimes combination of two or more strategies, and that needs to be devised very carefully based on what objectives you are trying to achieve. The restructurings have also been very critical from an inorganic growth perspective. It's important from a survival or for other strategic reasons, like for example, in respect of protecting your good assets from stress assets. It's also kind of done a lot of times for liquidity management or bringing in cost efficiency by rationalizing number of entities or merging or getting synergies with respect to some of the entities. So in true sense, restructuring and internal reorganizations offer companies and large organizations an opportunity to look at various means to either reduce cost or kind of drive sales or achieve some of the other strategic objectives that the organization would have put forward. And from that perspective, this session really is really important to understand the tax aspects surrounding the reorganizations from industry experts. Tax, I believe, is never the sole factor, neither the driving factor for any restructuring exercises, but is definitely worth one consideration because it ultimately becomes a cost. And looking at any restructuring exercises would assume a first analysis of a cost-benefit analysis, and tax becomes a large part of that cost. And therefore, that requires definitely a consideration. We'll discuss a lot of these aspects in our panel discussion today. And to help me with this discussion, I got a really elite panel with me here. Very quickly, I'll introduce our panelists today. I got Mr. Arijit Ganguly, who is the Senior Vice President and Group Head of Taxation with Emphasis Limited. We got Mr. Ashok Agarwal, who is Group Manager Taxation with Eicher Motors Limited. Mr. Mohammad Harun Karushi, Head of Tax Asia Pacific at Genpact Limited. And Mr. Sunil Agarwal, Head Corporate Taxation at Tata Power Limited. So got a really kind of knowledgeable and wide experience in terms of the panel that we have. And therefore, I would like to draw maximum experience from this panelist, and I would straightway, without kind of wasting any further time, go into the panel discussion. I would like to first bring Mr. Ganguly into picture, Mr. Arijit Ganguly. Generally, kind of the question that revolves around everyone's mind is that as a tax controller of a company, what are the key aspects that you look before undertaking any restructuring exercise that you need to consider before you even start off looking at a restructuring exercise? Mr. Ganguly?
Yeah, thank Maulik. Pleasure to be on this panel today, and thanks to all my other panelists, co-panelists. That's an interesting proposition. I think you began by saying, that tax is one of the consideration, and obviously not the driving force. And I would say that it's a byproduct because the origin of any restructuring comes from the business side, okay, and the CFO will drive it. Tax leaders, like all of us in the panel, will come much later in the picture. And typically when everything is done, we will be called upon to just have a cursory glance over either the BTA or any documentation and provide some inputs. By the time I think the damage would have been done. But be that as it may, let me tell you that I think substance over form is our core weapon. I think most of the panelists, and you would also agree, that if you do any restructuring work, I think we need to justify what is the underlying commercial rationale behind it. Is it tax motivated? Is it tax driven? Or is it really business driven? So I think that is the fundamental principle that has to be established and demonstrated. So for that extent, I think I would feel that we need to demonstrate and prove and in documentation. I think the most important is documentation. As far as I'm concerned, I feel that whether you are achieving any economies of scale, are you going to get any reduction in manpower overheads, or are there any synergies that you're going to be deriving? So all these critical aspects, or are there any benefits of integration, vertical or horizontal integration? So these critical aspects must be clearly called out and documented well. In fact, even the board resolution, which proposes a slump sale or a purchase slump exchange or a purchase or any demerger, must clearly outline these aspects, commercial rationale and justifications as to why the business is driving this. And unless these are really documented well, then we have the Damocles sword of Gar and Sar, which will come in very badly against us. And therefore, and I want to clearly caveat out of my personal experience, when things go wrong, nobody will come to your support. Okay, so we'll have to defend the revenue with our empty hands and with our consultants. So it's really makes sense if you can do the homework well, get the commercial rationale and justification. And rather, I would say you should prepare a position paper. I think as the tax leaders, we should prepare a complete detailed position paper in consultation with your external advisors, internal teams, and outline the entire commercial rationale and justification as given by the business teams. And therefore, from there, I think take it forward. So in our day-to-day work life, I think these are the critical aspects that we must keep in mind and be aware of the fact that Gar and Sar is always there. Section 50B has been amended. Okay, Rule 11 UAE has been brought in, where the fair market value of capital assets has actually replaced the old regime of sell consideration when we used to undervalue the undertaking for the purpose of avoidance of capital gains. Then there are poem consideration. I think one of the fundamental and biggest the danger today is poem. I think the poem risk must not be underestimated at all. For example, let me tell you a practical example where many companies would do externalization of IP. You want to create an IP holding company in a foreign jurisdiction. Let's take, for example, Ireland, one of the most favorite, having a low, effective tax rate. Now, if you are ignorant, or rather, if you miss the poem issue completely, then the entire objective and the exercise can be brought to naught. Okay, so the whole thing will go for a toss, because if the poem of the foreign entity or the whole IP holding company is deemed to be in India, then what is the purpose? I think you will lose the whole thing. So we should not lose sight of poem risk, which is a specific, anti-avoidance regime. Then Section 50 in relation to some slum sale. So while GAR and SAR obviously will come in, at later time, I think we should do the homework as tax leaders at the time of drafting the document itself, and we engage with our external legal counsel or the in-house legal teams and tell them very clearly what are the dangers, what are the risks involved, and ensure that the document bears out the commercial and rational and justification for the whole transaction.
Thank you, Mr. Ganguly. I think you made a very important point in terms of what is driving the internal restructuring. Is it the tax consideration that are driving, and are you actually doing that project for tax aspects, or is it really commercial? Sunilji, you want to come in over here and kind of elaborate on that a little bit and maybe share your experience in terms of in the restructuring exercise that you've seen. Do you see tax driving that, or do you really see that most restructuring exercises are commercially driven and tax may be an added advantage sometimes or added cost sometimes?
I completely agree with Mr. Ganguly that the tax is secondary. First is the commercial sales. So whenever issue comes for the business, yes, they want to do some restructuring, we should ask first, what is the reason, what is the object behind it? Whether you want to attract investors for that business, because quite possible you may be doing 3-4 business. So far as investors are concerned, they may be interested in particular business, not in other business. So that is the idea, or you want to attract loan at a reasonable terms, or you want to expand the market. What is the business rationale there? Based on that, then we will consider what are the tax consideration. And when we are considering tax consideration, we will consider the long-term position, at least for the next 10 years. Not only for that business, but as a group, as a whole, what is the position? So we will consider that we should create value to our investors, to our customers, market, as well as bank. So I feel tax is the second consideration. But as a tax leader, tax is important. Then we will see that what is the position. We will be having bad credit. We will be having a TIA reduction like infrastructure. Whether we will lose, what is the impact to it? Not only for that business, but for the group as a whole. And now, if we are going for slum sale, this 15B change is creating a lot of hurdle. It is going just against the basic principle of slum sale. So all these things we have to consider, but first we have to consider what is the object behind it? What is the commercial aspect?
Maulik, just want to add one thing to and supplement what Sunil said. I think people who are working, tax leaders who are in the listed company, I think often we get tempted to use restructuring as a tool to maximize, minimize, or optimize rather. That's the best better word. Our global ETR. Now so there's always a temptation that we should do some exercise, some restructuring here and there, international domestic combination, and so that my group ETR comes down. Now, while the temptation is really appreciable, but we have to be really mindful of the fact that somebody is watching. Okay, and unless we really take steps in strong documentation and with commercial rationale, as Sunil also mentioned, we will get into a big trouble later on. So I just want to have a word of caveat and caution there.
Right. No, right, Mr. Agarwal, Mr. Ganguly, I think you brought it that commercially it has to be very, very kind of sound and it has to be driven by commercial. Although our experience is by and large that a lot of kind of companies and clients approaches saying that like you, Mr. Ganguly pointed out, that can we look at our ETR by doing some restructuring exercise and can we kind of maximize our returns to the shareholders, etc. Yeah, Mr. Agarwal, you wanted to add on that?
One thing more, we should not be hesitate to play our role as a devil's advocate at the time of discussion. Normally what happens, people don't try to say the wrong things, the bad picture, but it is our role to play. That if what are the consequences, what may be the black side of the picture, we should show the manager, we should discuss collectively so that we are well prepared to face consequences later.
Right.
We cannot defer it for future.
Absolutely. Absolutely. Understand that, Mr. Agarwal. So one of the major considerations that I see, and when companies come to us for restructuring also, one of the major consideration is liquidity management and kind of ensuring cash flow at the right level. So I see liquidity management is the most commonly faced challenge between group concerns, especially a holding company requiring cash, or between sister company, there's one cash surplus entity, other is cash strapped. So Mr. Ashok Agrawal, I want to kind of bring you over here, and if you can kind of throw some light on what are the options or tools that could be considered by such companies to provide more flexibility in their funding requirement and movements of funds within the group companies.
Thank you, Mr. Doshi. So first of all, it is my pleasure to be part of this program. And I thanks to CII and program coordinator for inviting me on this August panel. So, so as you rightly pointed out that during the COVID, it has impacted a lot of industry across. And only the handful companies who are cash-rich company could manage easily. Otherwise, large part of the industry is suffering from the funds crunch or liquidity issues. And normally in the business, when we talk about the businessman, it is always the liquidity crunch, because businessman is hungry for growth, for profits. He tries to invest and by investing and doing the business to maximize the profit and create wealth for the shareholders. So rightly, so within the group companies, normally to proper manage the funds. So largely, basically, it is depends upon the varied factual metrics of each group's tax positions. So different aspects need to be considered. So there can't be a straight line answer. However, I'll put few options in the priority order. So first of all, this is loan from bank based on the guarantee or letter of comfort. So that is the easiest way to do it, because you can manage the funds in another company through the bank guarantee and letter of comfort or something. Second stage is the loan from the group company. So it has impact of deemed dividend issue. So one has to consider section 222E, its implications there. So that is to be taken care while doing any loan transaction between the two corporates. And however, there is no restriction so far as the Companies Act section 185 is concerned. Then third is the dividend distribution, basically. Now it is taxable in the hands of the shareholders. So one has to see how efficient it is to distribute the dividend, and whether it is for a group, it is tax optimization options or not, considering the liquidity management at the same time point. Next one is the capital reduction and buyback of shares. These are also another options where the group can explore. And little bit the capital reductions and buybacks takes little bit time. Buybacks generally primarily 3 months or so, and for capital reduction you have to go to the NCLT, which takes at least 6 months or so. So these are the basic options which one group explores to manage the funds within the group companies.
Thank you so much, Mr. Agrawal. I think you brought it up a relevant point, and you also mentioned dividend quite high up the order. And we are also kind of seeing that after the rationalization of the dividend distribution tax and bringing in tax and shareholders, a lot of companies are not really shying away from declaring dividends and paying dividends and using dividends as a cash management tool. Also, given the fact that India has taken care of the avoiding double taxation by, if one subsidiary declares dividend to the holding company has to further declare, at least there is no double taxation. So taking care of those aspects, etc., is really brought in companies to incentivize them to declare dividends, etc.
So one aspect, if I could take it up, basically, if holding company has a current losses in current year, right, and subsidiary company is distributing the dividend, then virtually there will be no taxation per se. in the current year. So one could see what is the factual matrix it all is. So that's from my side.
Right. Thank you so much. I'd like to bring Mr. Qureshi over here. Sir, we touched upon slum sale when Mr. Sunil Agarwal mentioned about the changes that are there. So in my experience, slum sale was the answer, or was kind of the number one answer where there was a requirement of a business transfer, because it provided a lot of flexibility at that time in terms of the cost, no regulatory approvals, timing can be flexible, it can be managed in a shorter time frame, etc. Now, with all the amendments surrounding the provisions of slum sale, what impact do you see on internal restructuring because of the slum sale transactions now requiring a valuation and all of those sort of things?
Thank you, Mr. Doshi, and good morning to all my panelists and all the participants. So yes, certainly slum sale was, and I think is, a widely recognized and popular method of business restructurings, especially within the group, because I think it provides a lot of flexibility. I think in terms of time, it is much more efficient. If you go through a court process, I think that at least takes 5 to 6 months, even with the NCLT. There are very little regulatory approvals required for that. So yes, it is a very popular method. A lot of people, a lot of groups used to do slum sales at book values. And now the law on that was not always very clear. But I guess because the law was not clear, everyone was actually doing it book values. And it was considered very efficient from a tax perspective as well. However, in the recent budget, I think 2 important amendments have been brought in. One is, I think they have tried to overcome the Bharat Bijli ruling in the case of the slum exchange. And now even a slum exchange would now be taxable. And the second and the more impactful amendment, which actually impacts most of the transactions, is now the rule that all slum sales have to be done at fair values. So obviously it is going to push up the tax cost of transactions. Now, fortunately, they have defined the fair valuation rules in such a way that not everything gets covered. So there are still intangibles like customer contracts and everything. Those do not get included, for example. But yes, immovable property, securities, those things do get included. And therefore, I think companies which are capital intensive or which have significant investment in securities, I think they will get impacted by this. They will have to follow the new rules. Fortunately, more labor intensive companies like IT and BPO companies, they may not be so much impacted, especially because the intangibles have not been brought into the tax net as yet. So while it is obviously, it does make it tax inefficient, but I would actually say that somewhere, I think fair valuation is the international norm nowadays. Right. When you look at more and more countries, look at basically US GAAP rules, IFRS rules, everything is actually driven by fair valuation. So yes, while it does make life a little difficult for us and a little costly, but I think we are moving in the direction of following the international norms. And I think fair valuation is here to stay. In fact, I think as things develop, maybe we'll see even those intangibles being brought in, the customer contracts, the know-hows, the goodwills, even those might get pulled into this over a period of time. So I think that is where we are right now. I think we will see maybe more and more people now moving to maybe demergers as an alternate to slum sale. But I guess they will have their own timing considerations, because demergers, firstly, the time it takes. Secondly, the tax office is now an important stakeholder in a demerger, and they can obviously come and file objections and everything. So, but I guess demerger might now be seen as some kind of a fallback to a slum sale.
I think you brought in very important aspect there, Mr. Qureshi. I think the fact that we still not included customer contracts, etc., in the valuation requirement in a fair market value, that at least provides a lot of leeway still to the companies to plan that. Although the requirement of fair valuation of other assets have come into picture. Mr. Qureshi, just staying on that slum cell and just one more additional question. The government brought about this amendment in the budget of February 2021, Finance Act 2021, and the rules were notified in May 2021 in terms of the valuations, etc. But the amendment is effecting from 1st April 2020. This, do you see, is anyway kind of, in some sense, a retrospective amendment, and government slightly going back on its words in terms of bringing no retrospective amendments to the law?
Yes, see, I think to some extent, I would actually agree it is to some extent retrospective, though not maybe very drastically, but at least for the last 1 year. Though I would hasten to add that obviously it's not very desirable, but I guess for last 1 year, 2 years, we have all anyway been so distracted with COVID and everything that not many transactions may have happened. But yes, I agree with you. It is somewhat sort of undesirable. I mean, they could have brought it from April 21 as well.
Absolutely. Absolutely. So I think that was one of the major worry from an industry perspective also, that transactions that had already taken place and kind of how to redo those transactions, or how do you kind of look at the tax impact of those transactions. And plus the government hasn't provided any relief in terms of shortfall of advance tax payments and in the interest consequences, etc. thereon, where as a matter of fact, when the advance tax was payable, the provisions were not there. So we hope at least that in future we don't see such kind of an amendments where they border on the kind of retrospective, retroactive, whatever we want to call it.
And Mr. Doshi, if I can just add here, just one final point here. I think to the extent maybe transactions which have been within the group, maybe people can still get their arms around and try to figure out, I mean, what is the tax cost, even if it is done at fair value. I think it remains within the group. But if transactions have happened between third parties, I think that is going to get really messy, that what is the additional tax cost, which party picks up the tax cost. I think that's going to be a little difficult to deal with.
Absolutely, absolutely. You really kind of brought those points and really important for companies to reconsider whatever transactions happened in the period of 2021. Moving on, Mr. Sunil Agarwal, I wanted to kind of bring you over here and I want to talk about stressed assets. Kind of that's another consideration that we see companies looking at restructuring, and where possibly one of the business units is exposed to debt restructuring or IBC actions, etc. And they want to do something to safeguard that. So what are the factors or what are the aspects that you look at when you are looking at stress assets within the business? A, from a company which already has stress assets and they wanted to kind of look at protecting the other good assets, and B, from a company who's looking at buying stress assets. So if you can kind of a little bit elaborate on both the sides and see what are the considerations that the companies have to consider and keep in mind when they are looking at this entire scenario from a stress assets perspective.
Okay, I will first consider the stressed asset within the group. If there is a stressed asset within the group, we have to see what is the reason. Whether we are really competent, capable of running that business efficiently. If we are not, why to run it? Why not to dispose it off? Tax consideration are secondary. But at times, it is not possible to sell off that business because of maybe reputation risk, maybe regulatory regime. Though we want to sell off, we cannot. In that case, we have to see, okay, if we cannot sell off, how we can reduce our profit, losses. We cannot, that is, and really, as we are in regulatory business, we have faced it. And similarly, you see in infrastructure company, mainly in power company, lots of companies are there, they are facing it. And now, second is the external stress assets, where bankers are having control so far as shareholding is concerned, but actual management control may be with the old previous promoter, though he's a defaulter. At that time, if you want to acquire those assets, banker is ready to sell it, you are eager to purchase, but there are certain problems. Quite possible, earlier management may not have complied properly. They may not have filed return properly, may not have paid TDS properly. How to safeguard it? So in that case, if it is coming through IBC route, in that case, we can ask the court to mention it for the previous action. The new management, new company will not be responsible. And fortunately, there is a clause in IBC. They can waive off all previous action or non-action. So we have to take care of it. But at times, banks are not preferring to go through IBC route. They are suggesting you purchase directly. In that case, naturally, we have to go to see what is the status of the old pending cases, what is the potential tax liability, and the main issue which may arise of Section 281. Quite possible, banker is having lien on the shares, but in the books of Companies Act record, it may still be continuing in as the shareholder is the previous owner. And quite possible, earlier promoter may be having used tax liabilities. In that case, we have to see and we have to try to obtain 281 permission. No, practically it is really difficult. But we have to take it so that there is no surprise element if you are going to acquire. So in that way, naturally, when we are going to acquire, we have to take care about the past litigation, past compliance, as well as 281. These are the three major points I feel one should consider.
Right, sir. I think that was really relevant, sir. So any particular insights for companies in terms of how do they, if they are taking over through IBC, how do they safeguard themselves from penalty risk? You might have to even any other aspects that companies need to consider?
Yeah. So in that case, when the proposal is submitted to the court to take over a company, IBC company, in that case, you have to put the proposal key, yes. So far as earlier action or own action by the earlier management is concerned, you please waive it off. From the date it is being acquired by the new promoter or new management, we will be responsible. But for the past action, what we can do? And it is there right now in India. So many stressed companies are there under IBC, where the promoter is a foreign investor. They are not complied properly. How even they have not filed the return? How you will do it? So that one has to take care.
Right, sir. Understand, sir. Moving on, Mr. Ganguly, I wanted to bring you over here and kind of talk a little bit about one of the aspects that you mentioned in your opening remarks. If you talk about restructuring, the synonymous to restructuring is goodwill. And we have seen goodwill kind of getting used, abused, whatever we want to call it, and depending on whoever's perspective that we look at it. And we had looked at several cases where genuine goodwill was also getting created and kind of getting amortized, etc. So there have been a slate of amendments around goodwill and now kind of not allowing depreciation on goodwill. Finally, kind of overruling all the court rulings, etc. There. What is your take on that? How do you see these amendments and around the goodwill, and what impact it would have on deals, and how would companies now look at restructuring, considering the fact that goodwill no longer will be depreciation? Do you think they will be looking at bifurcating in other intangible assets, etc.? What's your take on that, sir?
Yeah, thanks, Maulik. I think that's a very topical. I mean, goodwill has been one of tax leaders' favorite topic or other aspects of depreciation in relation to amalgamation or slum sale, etc. I think the fundamental problem is goodwill is not defined in the Act. Okay, not Section 32. It is neither a tangible, although it's an intangible, but Section 32 doesn't define it as an intangible. Okay, so that's the main problem, and the litigation all started because of the lack of proper definition within the statute itself as to what do we mean by goodwill. Goodwill can be self-generated, it can be acquired, purchased goodwill. Now, so there were a whole host of litigation in the country till 2012 when Supreme Court in the CII versus Securities Limited, they came in and said enough is enough, and therefore goodwill is an intangible. It was reported in 348 ITR. So the main aspect was that Supreme Court clarified that by following a doctrine called doctrine of wisdom generis, that if you look at the definition of Section 32, it says, I'll just quote, that it includes the know-how, patent, copyrights, trademark, licenses, franchise, or any other business or commercial rights of similar nature. Now, this is exactly the phrase where we have been taking shelter, and exactly where Supreme Court also enunciated, saying that goodwill, the way it arises, like it arises in excess of purchase consideration paid over the net asset value or fair value of assets taken over. The difference is nothing but any business or commercial right that for which you are making a payment. And therefore, it ought to be within the ambit of Section 32, and therefore, it is to be deemed as an intangible asset following the principle of adjustum generis. Now, the problem is things were settled. And as we say, man proposes, God disposes. So, Government of India in Finance Act 2021 brought the whole thing again back to square one. They said, no, nothing doing. And therefore, goodwill is not an intangible asset anymore. It cannot be, it has to be removed from block of asset under 2 subsection 11. And a whole host of amendment was carried out. Section 50, Section 55, everywhere the amendments were carried out under the budget. And so the resulting problem is that goodwill today is a very difficult proposition for us. So if you are, and this goodwill, just mind you, Maulik, I think regardless of the way it arises, if it arises through amalgamation or slum sale, whatever be the case, everywhere you cannot take any tax shield at all on goodwill post-acquisition. So that's a problem that we are facing today. And now, is it retrospective or prospective? I think it's both. I think in my mind, it's both, because for new deals, if you're negotiating with the your new buyers, etc., yes, you cannot no longer factor in the tax benefit of the depreciation on the goodwill that as a buyer you will get. So that has to be factored in the price negotiations. What about the prior deals? Yes, the law says that if you have already availed, and this is the law is actually applicable from AY 22. But there is also a corresponding provision which says that if you have already claimed cumulative depreciation till AY 21, then that has to be adjusted from your cost of acquisition. So I feel there's a retrospective effect also. So, but how Section 50 has to be adjusted, that is not very clear. Because if you may have an opening WDV, there you will have a bundle of assets. Look, you have intangible assets also including goodwill. Now, how do we segregate the cost of acquisition? It's not very clear to me personally after having read the fine print. But I think some clarification is required from the board. So in terms of operations, since it affects cost of acquisition under Section 55, and it asks us basically that if it is the purchase goodwill or then the original cost to the original owner, previous owner, or if it is coming, the goodwill is acquired through a gift or amalgamation, then cost to the previous owner, all these costs have to be adjusted, and depreciation has to be adjusted in the cost. I think to that effect, Maulik, I feel it has a retrospective effect. It is not, so it's a hybrid actually. The way the statute amendment has brought in, I think it has a hybrid operation. It affects your past deals also and the go forward deals also. Right. So the question arises, for tax leaders like us, how do we handle it? And because we cannot, we'll have transactions, right? Business will have transactions, we'll have restructuring. So the fundamental aspects which needs to be looked into is basically the valuation. I think the focus, because today under the ambit of 32, while goodwill is a black sheep, other intangibles are not. So they are allowed. Therefore, when you do a purchase price allocation, I think the PPA becomes a very, very critical instrument and tool. So when you engage with external valuer, we have to ensure that we ascribe maximum value to other intangibles, as Mr. Qureshi was mentioning, customer list, contracts, or other customer intangibles, okay, rather than assigning value into the goodwill itself. Because goodwill under the, if you look at Ind AS 103, which talks about business combinations, it is subject to impairment. So even for us, from a CFO perspective, I think today after this new amendment, most of the listed companies, where they are getting into deals are having this biggest problem, because if goodwill is coming in your console for financial statements, it's going to be a drag on your EBITDA, okay, because you cannot depreciate it. So therefore, it is subject to impairment test. Whereas if you look at the US and the international regulations in US and Canada, goodwill is typically part of Section 179, what we call 179 intangibles, where these are clearly amortizable over a 15-year period. Unfortunately, in India, I don't know, the government made this, complete U-turn and they made this amendment, but it is not in line with the international developments and international rules, where no amortization and tax depreciation under Section 179 in the US and Canada is allowed. So I feel the PPA and the valuation should be a focus area for tax leaders. I think when you engage with external valuers and ascribe maximum value to other intangibles and clearly document when you're doing the merger agreement. Because I have a practical experience where in a transaction, of course, it's not pertaining to my own organization, where in a particular transaction, the acquiring company did not pay attention to the fact that in the balance sheet, in the closing balance sheet of the target entity, there was no goodwill at all. And in the SPA, it was clearly mentioned that the business had no goodwill. Now, post-acquisition, when you're doing a PPA, you cannot ascribe an artificial value when the business on the closing had no goodwill at all. How will the IRS allow you depreciation under Section 179 through PPA route if in the closing balance sheet you don't have a goodwill at all? So these are minor aspects which have, as tax leaders, we have to be very, very conscious about. And when we are advising our CFO on the board and others, we should be clearly abreast that these are the typical areas where goodwill can, I mean, if you're a little not consistent with the international rules, or if you're not little I mean, hawkish about these matters, then really we can lose tax shield on goodwill. So that's my take, Maulik.
Right. No, thank you so much, Mr. Ganguly. I think you explained the aspects surrounding goodwill very well. When I was kind of learning, to me, goodwill always meant that it's a sum total of all intangibles that business would carry, right? It's an overarching thing in terms of the intangibles. And I thought that that still survives. Like if the business has intangibles, it's just taking a painstaking effort to identify those intangibles and value them at the time of doing the PP. And you kind of really brought that point across very well. So moving us up, Mr. Ashok Agrawal, I wanted to kind of talk to you about one more aspects when we consider restructuring, and that is on the valuation from a transfer of share perspective, right? You have Section 50 CA, you have Section 56, the double taxation arising on account of difference in valuations. How do you deal with this kind of a situation? And is it really fair, in my asking a valuation to be done in a non-related party transaction? You are selling shares, it could be a distressed sale. Is it fair to describe or subscribe to a valuation mechanism?
So, right, Mr. Doshi, basically, whenever you transfer anything, the two-party interacts. So they have a commercial aspect of it. Buyer sees some value in it, and that valuation is, see, what the potential value buyer sees is that is a valuation that you can define in certain way. It is based on DCF, net assets value, whatever the method would be. But ultimately, the buyer who sees a future prospect, the potential or the profit he can make out of this purchase, that is the value is, and that is a real value, which should be considered. However, opposite to that, when we come to income tax, it is a deemed value, deemed provisions. So it is a defined value rather than commercial-led, commercial principle-based value. What we are doing in Section 56 to 10, 50 CA, they are basically a book value method, nothing else. While doing the book value methods, what they are doing is they are doing assets as per book value, largely except the this land and buildings, immovable property, and then another thing is shares. If I forget this jewelry, which is normally not a part of the assets group block of any company normally. So they are bifurcated in 4 segments: jewelry, etc., then shares, then immovable properties, and rest of this. And they are reducing the whatever the liability sitting in balance sheet, except these contingent liabilities and 2 more exception or exclusions. So largely they are doing the book value method. Now let's discuss 2 ends. One, a company has started, which has as a growth potential a lot, like a startup now, Flipkart, you talk about the Amazon, you talk about the Paytm, right? If you value these companies based on the book value, will get nothing. Where the growth potential is much, much higher, then you have to see the growth potential. And that is what the crores, thousands crores, lakh crores, we are talking about the valuation of these companies, right? And another end is a company where is in declining or dead phase, where the company is going to be liquidated. There you have a high book value base, but the potential market value is very low. Now, the Section 56 to 10 or 50 CA takes care of a situation where the actual fair market value as per the Section 11 UA or 11 UAA is more than the actual transaction. There they are taxing it. So if actual value is higher than the FME as per Rule 11A, that is taken care already. Tax has to not to bother it because they are getting actual tax. Whereas in the declining phase company, they are saying, boss, you have already declined, you're about to die, but give me the taxes based on your book value. This is really unfair. And that is what causing the entire thing. We are discussing substance over form. And I think in every panelist has discussed about it. When I'm doing transactions, department tells me to prove what is substance. You're not doing for it for basically a tax saving only. Whereas in my case, when I am in declining phase, they are not looking substance. They are saying, let's come on the form. What is sitting in your balance sheet, we will see that. We will not go into the substance that this company is dying now and don't have any worth. So what is the actual transaction value? Let's take that and tax it. So these are two basically different corners. And why, if we see the genesis of all these happening in circumstances, if you refer, I can refer one case laws where this Karnataka case laws, Boruka engineering, where the revenue contended before the court that the actual purpose of transfer of share was transferring the underlying immovable property. And before these all amendments and this 56 to 10, 50 CA, so that is why the value should be, share valuation should be done based on the actual value of the assets, not the book value or something else. Then the court said, as per the legal provisions existing as on date, the valuation done by the SSC is within four corners of law. If Parliament want to change, then change it. Now what they did is to capture this anomaly or to capture this transaction and to tax it, what they did is you value the buildings or immovable property based on the circle rate, right? Now you have arrived at, so to plug those few SSCs, you have generalized one principle, you forget the substance over form, and you bring the assets-based taxation. So that is really unfair. And when we talked about, so the department wants to maximize their tax revenue. If you see section 50 CA and 56 to 10 interplay, what it says? It says if fair market value is higher than actual transaction value, then differentials will be taxed in both the hands of, in the hands of buyer as well, in the hands of seller as well. Let's say, based on the commercial principle, I have arrived value 1,000 rupees of this share. And based on the book value, what they prescribe under 11 UA, it is coming, let's say 1,200, right? So now this 1,200, who was buying these shares, 200 will be deeming income under section 56 to 10. And at the same time, on the seller side, the department will consider the full value of consideration 1,200, not this 1,000. So at both the ends, they are taking a higher tax, whereas the actual things is 1,000. I'm not denying that fact. Few entities, few SSCs are doing some restructuring, some transfers and taking the benefits. Yes, it is very much right to plug to catch those defaulters or willful SSCs. But to plug those, there is a famous saying in Hindi, गेहूं के साथ घुन पिसता है. Now it is a reverse order, घुन के साथ गेहूं पिस रहा है. So basically for few things, you are basically penalizing the entire industry, and which is, I've seen few cases, just because of these provisions, deal couldn't happen. Party was ready to exchange the things, and largely it is impacting the all dying companies where there is no value.
Thank you, Mr. Agrawal. I think you brought in really important point that it is in these transactions that people really forget about substance. To me, the fact that there's a valuation requirement from a non-related party transaction, it itself kind of undigestible. Like, how can you a third-party transaction and create some deeming fiction over there? And just to kind of penalize 1 or 2% of the people you want to kind of look at. Plus, the government always has the general anti-evidence regulations that sword of guard is always hanging. Yet, you are requiring every transaction to go through these things. Sunil sir, you wanted to add over here something?
Yeah, I would like to add what Ashokji has told. Actually, you may consider fair valuation rule in respect of the related party transaction, whether it is fair or not. In case of non-related transactions, where the price has been discovered by the market through bidding process or the open auction, how can you challenge that? No, I will not agree with this price. We will agree only with the rule 11 UA. And that is the main reason that the bankers found problem to sell their stashed assets. Because they know stashed asset price is high. Plant and machinery, which is appearing in the books, is not of that much value. That's why they are in loss.
Absolutely.
Bankers are ready to sell at the less price, but because of this mischief of the Section 56 and PCA, certain deals does not take place.
Absolutely. I wonder if anyone has done a book 11-year evaluation for the Air India transaction and see whether the government or the acquiring party would have to pay more taxes because of that. Moving on, Mr. Qureshi, I wanted to come in one more aspects, and we are really kind of short of time. So I just wanted to request the audience, if there are any questions from the audience side, they can put it in the Q&A box and I'll take it up with the panelists. But Mr. Qureshi, before the audience questions, the other form of restructuring that we have seen by and large is on the limited liability partnerships. And obviously not really relevant for very large corporates, but a lot of small and mid-sized enterprises are looking at moving from private limited companies to LLP structures, given that now the promoters are getting taxed at 42% and the corporate tax rate of 25%. It's really the LLP is still much cheaper from a tax perspective. What are your thoughts around that, and what care or considerations that people have to take it?
Mr. Doshi, I think maybe a couple of years back, the answer would have been very simple. LLPs were definitely more efficient because, as you said, there was no dividend distribution tax and there was no tax payable by the partners. But I think things have changed over the last 2 years. Now it is more a case-by-case analysis, really. If you look at corporates, I think the tax rates range from like 15% to maybe 30% on the two extremes. Dividend distribution tax, which was a hefty 20%, has now been replaced with a shareholder level tax, which could be 5 to 10%. So I think now every transaction, I guess you have to really look at what is the fact pattern, what is the status of the shareholders, especially if you are looking at non-resident shareholders. Then there are some treaties at least, which could give you even like a 5% dividend tax. Though with this OECD Pillar 2 coming in, that might be a thing of the past. But I think based on that, we'll have to do your own analysis for each transaction. However, I would like to flag one point here. So I think we spoke about can LLPs be really used to move away your business from a corporate to a LLP structure. I would think the migration itself is a bit of a challenge, because I think the government hasn't clarified the rules on that. If you really look at the movement, the exemptions which are provided are really de minimis, maybe 60 lakhs of profit and 5 crores of turnover. It doesn't really help any of the large corporates. So I think the uncertainty around that is quite significant. And I doubt any large business would really get into moving their existing business from a corporate to a LLP, even if the LLP's tax attributes are more efficient than the corporates. Now, perhaps we might see newer businesses or fresh businesses getting set up in LLPs, but I doubt any substantive existing business will actually move.
Right. Thank you so much, Mr. Qureshi. I think, Naina, I think we are just on time, right? So we already have exceeded a couple of minutes beyond our allotted time. So maybe I'll take up an audience question and then kind of give this closure to the panel discussion. In the meantime, if there is any closing comments from any of the panelists, any tips that panelist wants to kind of pass it on to our audience with respect to some of the aspects on the restructuring, please kind of feel free to do that. We got one question which is relevant from our discussion perspective, and we want to take that, is that if you're looking at a global restructuring project, indirect transfer and the tax on indirect transfer also plays a very important role. So any take on that? How do you kind of, because the amendment we saw, then the retrospective amendment, the retrospective part at least was taken away by the recent change in the and the recent act that the government pronounced. So how does one look at the indirect transfers? Mr. Qureshi, you want to come here in terms of the overall impact on the global restructuring projects?
Yeah, so Mr. Doshi, so I think, in fact, while we have been talking a lot about all the negative developments which have happened in the last couple of years, I think one very important development which we should bear in mind and we should give credit to that government is really the clarity, the much awaited clarity they finally provided, even though they took 7 years to provide that clarity, basically saying that indirect transfer, at least removing the retrospective applicability of tax on those transactions. So that obviously was a huge uncertainty with people, all the transactions they had already done. I think that is a huge positive move by the government. And I would really think that that is one very important aspect that we should bear in mind.
Right. And one more question, maybe Sunilji, if you can throw a little bit light on this. I don't know whether it's kind of too premature to discuss about it or not, but with Pillar 1, Pillar 2, and the kind of changes coming in terms of the global taxation, wouldn't tax play a very important role in deciding factor for business restructuring? So possibly wouldn't Pillar 1, Pillar 2 bring tax back to the center stage and be a deciding factor for restructuring? That's a question that we got from one of the audience.
Maulik, so far as overseas restructuring is concerned, we have never preferred any company to be merged with the Indian company because this is not tax friendly and lots of hurdles are there. But we always prefer the merger within the same jurisdiction because in international market, merger issues are very simple. It is easy. But we are not recommending anything else with a cross-border transaction with Indian corporate.
Right.
I cannot comment on it.
Oh, that's fine. That's absolutely fine, Mr. Agarwal. So, Mr. Ganguly, Mr. Ashok Agrawal, any last words on on the restructuring topic and how companies should go about doing that?
Yes, Maulik, I think thanks to all the panelists. I think for beautifully summarizing all the core and critical issues that are facing all of us as tax leaders. I think as passing and concluding remarks, I would say do your research. Okay, I mean before you jump into the transaction, okay, please research and prepare a position paper. Okay, from the tax department internally or externally, take external legal counsel help or go to any Big Four or anybody else. But please prepare your research position paper. And thoroughly, convince yourself first, by putting into the shoes of as if you're a revenue auditor, whether this sails through or not. Okay, we remember I was reading one case in 2017, this Mumbai in the NCLT, there was a judgment of Gawa Investments and Ajanta Farmers, a case where income tax department absolutely, came in and played a havoc, and the NCLT actually struck down the whole scheme of arrangement and amalgamation. So now with the whole NCLT ballgame has changed. The tax department have become much more vocal. They are become knowledgeable, and there's a lot of exchange of information between the CBIC and CBDT. So the entire tax landscape has become very hot. And your opponent is very, very formidable. They are very knowledgeable and formidable. So you never know from where what will come. So prepare yourself. Okay, so do your research and the documentation. Please focus on your core documentation and position paper and take proper advice, and then only you jump into the transaction. That's my advice.
So completely agree with Mr. Ganguly. So there are 3 stages rightly explained. First, research about the transactions, whatever the implications will be going to happen, and then well documented. These are 2 pillars, basically. I'll say pillar 1 and pillar 2 of restructuring. So where we must stick on. Otherwise, tomorrow there will be certainly challenges in the assessments and further proceedings.
Right. Thank you so much. Thank you all the panelists. Really enriching discussion. I really enjoyed and there was a lot of learning out of this for me at least, and I hope our audience is also benefited by that. Thank you so much, everyone. Thanks to the audience. And Naina, with this, we can close this panel discussion, and over to you.
Thank you.
Thank you.
Thank you so much.
Thank you, Mr. Doshi, and thank you all our panelists. So now we will move on to the next panel discussion, which is on self-certification of GST audit, the road ahead. May I now invite Mr. Sanjay H. Chabria, Director, Next Dime, who is going to be moderating this panel. Over to you, Mr. Chabria.
Thanks, Naina. I hope I'm audible.
Yes, you are.
Yeah. Okay. Thank you. Thanks a lot. Thanks everyone for joining in. Maybe I would directly start with the self-certification GST audit. why was this topic being picked up is basically to understand that now that, the way it started, I'll maybe go or walk through the roads, basically that when the GST got introduced, there was a lot of confusion that what things are going to happen. And the understanding which came in through, at least, was that, okay, now the VAT audit actually has gone to rest, and whatever the anomalies which were actually going through from getting this validated at different states, because some states accepted VAT audit, some states said, they do not want to have a VAT audit, and therefore the moment GST got introduced, the relief or the sigh that, the industry at least started taking over, that, okay, now that the VAT audit is gone. But the moment this got introduced, there was a section 35 and section 34, which specifically pointed out that, okay, there is going to be a GST audit in place, which is going to audit all your transactions for the year. While there was nothing specific which came in through, there was no return, there was no for filing, there was no guidelines which was given to it. And so again, there was like a confusion. Over a period of time, in fact, more than a year, the department did come out, the GST, did come out with this specific returns, that how the form GSTR 9 would look like and what are the things which is to be filled in. And there is a reconciliation statement which will have to do with your with your purchase register, which had to be classified into different buckets. And then this also had to be certified by a chartered accountant, while there were like a lot of writ petitions filed that why only a CA should do, and there was a relief at least that, okay, cost accountant was also given this permission to at least start doing the certification. And therefore this came into being, but a due date of filing was again not fixed, and it kept on pushing, and it kept on moving on from September end to December end to maybe March 2020. The last date, at least for filing, finally came that, okay, for 17-18 you will have to file by the 31st March 2020. Post that, somewhere in the budget, okay, in 2021, while the issue of who needs to file a GST audit was again a question, because the turnover was kept on getting revised, that people who had turnover of more than 2 crores were in the in the GST audit bracket, and the more than 5 crores actually get this certification done specifically. So who files GSTR 9, who files GSTR 9C, that was an anomaly. February 2021 saw a welcome change, wherein they brought in saying that, okay, for in the section itself, rather than putting out a notification, wherein they specified that every company which is more than 5 crores will actually have to do a GST audit. However, they deleted the subclause for 35(5), wherein they specifically called out that, okay, this had to be certified by a CA or a cost accountant. Eventually, the reading came out in this way that, okay, while the certification by a CA or a CW is removed, but now it will get self-certified by the company. And that is what the notification at least called it out. And therefore, the self-certification now sees the sun that, okay, the whole movement of a CA signing to the company taking the owners is what comes to being, and that is what we are looking at now. And at least from that perspective, the due date when this is going to happen for the first time is the 31st December 2021. So the first self-certification is just up and coming, and therefore calling this out to the industry that, okay, this is that's the way it goes. So for the panel, I would maybe introduce, we've got the panel, Rakesh Gupta, who's the Group Head Tax, KEC International Limited. Thanks for joining, Rakesh. Prabhat Ranjan from Controller, he was a Controller at GST Taxation at Audit Limited. We also have Sushil Solanki, sir, who's the Principal Commissioner and Customs Service Staff, retired currently, and he's also practicing as a GST expert. Just to give us some understanding from how specifically, the industry is looking at it, how we consultants are going to look at it, and how the department is going to at least, take this forward. This would be mostly the, discussion. So thanks everyone for joining. Thanks a lot for, coming forward. So, Rakesh ji, maybe to start with you specifically, maybe I would want to understand how is the GST audit scenario maybe changing due to removal of the CA certification at your company? How are the things, being charted out at your company? How are you picking this up specifically at your end? And how are the things that you would be doing it? Maybe can you maybe throw some light on us?
Hello, hi Sanjay, and thank you Sanjay, and thank you CII to having me here. Hope I'm audible.
Yeah, you are audible, Rakesh.
Yeah, so means like this is a very welcome move from the government to as far as from industry perspective to remove one of the compliance requirement to get this annual return audited. Okay, so may not be good from the CA fraternity point of view, but it is as far as if you look at the industry perspective, I think there are already a lot of compliances which industry was burdened with, and at least one this compliance is removed. And you know that audit has its own nuances actually. Okay, so once on one side, one can say that it is the ease of doing business, but the other way is like it is a lot of onus is also placed on the industry.
Right.
Okay. Once it is a self-certified, and the way the language is there of the certificate, if you look at the section Form 9, which is to be self-certified, which is to be signed by the authorized signatory of the company. The language is very harsh language. One can say that it says that whatever that form is, whatever the number which is disclosed is completely true and correct. And it's a very straightforward statement in that. And also the other language is like that if any benefit, if any reduction in the GST rate, the benefit has been passed on. So mainly the two things which this form asks us to certify or ask the signatory to certify that that everything has been, whatever is disclosed is true and correct. And it's not a true and fair view like we have in general in the our audit statement. And second thing, nothing is concealed. Okay, so very straightforward and very harsh kind of language which is there, and put a lot of onus on the signatory also. Okay.
Right.
So though it's not the first time which we will be doing the audit, right from 2017-18 we have been, and even prior to that audit we used to do actually.
Right.
So all system processes, I think there will be those processes were already in process, already in the system.
Right.
I think that just getting this certification, self-certified life will not change dramatically. But definitely onus is much higher actually, and the person who is certifying, who is signing, will be more cautious. There will more and more checks and balances which needs to be placed in the system, and I think all corporates are well prepared for that. At least I can tell about my organization. A lot of system was already there, and it is a continuous process actually. We are learning day by day the way the law is evolving.
Right. So in fact, you pointed out at a very right thing, sir. Basically, the signing it as true and correct, it was always a hue and cry for the CA fraternity. And therefore that got from true and correct to true and fair, at least in the audited statement. However, now that, the onus is getting passed on to the self-certification, maybe, a director or maybe an authorized signatory will have to sign this, saying that everything what we are signing is true and correct. And actually it's going to raise a lot more questions and things like that. And maybe the internal controls will have to be more robust. Prabhaji, maybe what is your view on this? How is your company, at least equipped to handle this, and maybe how are they able to, at least at your end, you are able to pick up that, when the thing moves from a CA certification to a self-certification. What's your view?
So thanks Sanjay ji, and good afternoon. Hope I'm audible.
Yeah, you are.
Thank you so much. And thanks CII for having this enriching session. I must admire even the previous session. So thank you everyone. Coming back to your question, Sanjay ji, maybe this is a cricket season, so let me put it through an example. So I normally see this audit as a kind of warm-up match before you go and play the final league. Okay. So this helps you identifying your ground reality. Where do you stand before you go and stand before the authorities? So it's a ground reality check, whatever you have as a kind of, we can say, as a SWOT analysis. So that's how I see. Normally, if you look at the previous audits, we all must have experienced that the risk and responsibilities, which was earlier being shared with the auditors, is being now completely shifted to the companies.
Right.
So the situation completely demands now to have more robust internal control checks and balances in place. And therefore, the key aspect which I look at is the reconciliation between the financial statements and the GST returns which you process, which you file. So it is very important. Normally, say in industry or from even the audit perspective, we consider this as an annual exercise.
Right.
My recommendation, and that's what we are believing and now doing, is automating a couple of things to make sure that we have a facility and process in place to reconcile our accounts, the financial statements, with the GST returns on periodical basis, so that you can avoid and you can put more kind of checks and balances to have any surprises at the end of the year.
Right.
So this is how I see. So entire responsibilities on industry now. We have to put more and more, kind of robust checks and balances in place.
Right. In fact, interesting thing that you brought in this reconciliation, which is going to come in. So any internal controls that you're looking at from your end, anything that you've put at, at the first level itself, that, everything actually gets sorted out at one level itself?
Yeah, exactly. A couple of automation things we have done wherein you pull out the TB and the kind of financial records on which you do a reconciliation with the financial statements. You are not only relying your registers, you are looking at the GLs also. So it is important that you look at what is going in the financial, because that's the end of the day, which is a base for anyone to get into, and the reconciliation with the GST returns. So it's important that we do that reconciliation. If possible, every month would be advisable. If not, at least have a process for a quarterly review.
Absolutely. Absolutely. I agree. In fact, it's not just a two-way, three-way. In fact, there's a triangulation which we actually generally run, and that's what we need to do. And now there's an added thing that, you've uploaded all your transactions. So now you are exposed to the department with all the things being exposed that, it's from income tax also, from all the other filings actually are going to start matching whatever you reported. So I agree. Rakesh ji.
Now, if you'll see the GST returns are not only being reconciled with the financials, what you are reporting in income tax, what you are reporting in your cost accounting, cost records. So everything has to be compared. So
absolutely,
things have to be well in place.
Absolutely. Yeah. So, thank you. Thanks. Rakesh ji, are you doing anything from mitigating this risk from the self-certification perspective? Anything additional that you're picking it up? Like, last time you did mention that, you're doing a lot of internal controls. Anything that from automation perspective or anything that you're picking it up from internal control or risk mitigation perspective?
Yeah, Sanjay, means like if you look at the way GST has evolved or evolving over a period of time, actually. I think, and the way department has become aggressive, actually, and the kind of department is now, first time we are looking in the history that revenue department is much ahead, actually, in their automation, in their data intelligence, in the way they are using and analyzing the data, actually, the information availability with the department. And I think corporate has still to catch up with the way the department is progressing, actually, and that put a lot of additional, not only this because of this requirement of removal of audit, actually. I think otherwise also there is a huge responsibility now on the organization when they file their GST returns and when they report the numbers. So all those initiatives means like that e-invoicing, your e-way bill, your various reconciliation requirement, and the new provision which is now which is likely to be affected is that credit should be availed only when that your supplier has complied, actually.
Right.
So, and also as we hear that there may be complete change in the way we file the returns, actually. More and more data will be auto-uploaded, auto-populated, actually. Okay. So I think we are already facing a lot of challenges. This is the additional burden. Just removing this audit is is I think additional burden or additional onus is placed on the companies. Okay, but the situation already demand that, and the kind of data is there actually, and the kind of information is which we have to deal with. I think a lot of automation is the only solution.
Right.
It is not. Right. It is not possible manually to deal with the tremendous data and reconcile all numbers.
Right.
So a lot of processes are already in place. A lot of processes are in. We are still trying to develop some more processes. I think more and more use of the robotic processes, better use of this ASP, GSPs. Also, your internal ERP system has to be also be very robust. That lot of internal check means like at the time of you do the entry, at the time of the way you retrieve the data from the system. So, so the entire process is means that every periodically we keep on reviewing it and keep on checking where are the lacking, where are we lacking, what are the defaults, and how can we improvise it. And this is a continuous process, and I think just to repeat means like this self-certification has put more and more on us actually. Now the things are we have to be more careful and more cautious whatever we do.
Correct. So this brings me to the important question, and maybe how does the department is going to change their methods of picking things up, and maybe how the department is actually looking at this. So Sushil ji, maybe maybe I would want to ask you this, and thanks for attending, sir. The method, what is the method, and how are we changing the assessment or audits? Now when the things move from a say a CA certificate to a self certificate, and what are the changes in the risk parameters that we are looking at overall? At least are there any changes that we are looking at?
Thanks Sanjay, and thanks CII for inviting me to speak on this important topic now. Before I answer your question that how the department is going to select the taxpayers which are going to be audited, or whose records are going to be scrutinized, and what methods now. Let me give a little background of this, that how the things have changed in the GST era, and which is going to make changes in the selection of the taxpayer for the purpose of scrutiny or the audit, or even for the investigation. The first important change, which you might have noted, all of us know, the type of data available with the department is too large now. All your B2B transaction invoice level is getting captured, which was not the case earlier in all the states, at least the center, in the central excise and the service tax. We were not, capturing the data, invoice level data. Then we have the e-waybill data, which was never happening in the past. As far as center is concerned, some of the states were having e-waybill, but not capturing the data. Now we have the e-invoices. Now, top of it, you have got RFID now, this, radio frequency identification for the vehicles also. And this is online, I don't know whether how many of you might be knowing, it's an online capturing of RFID data has already started. When a truck or lorry passes a particular toll naka, the information reaches to the central server. Now, this is not the end of the list now. You have GSTN 9 and GSTN 9C. On top of it, when I was in department, when we were doing our audit, the first part was always doing the reconciliation, being a chartered accountant, reconciliation of financial with the your tax records. Now, that is also getting captured in 9C now. So now look at the type of data available with the department now. It's not only the quality, the quantity of data, but the most important, the government has invested financially and from the resources point of view too much into the data analytics. I'll use the technical word, data mining, data warehousing, and data analytics now.
Absolutely.
As early as possible in 2018, the CBIC, which from central government, they started this Advaita program. Name was Advait, basically, Advanced Analytics for Indirect Taxes. At the same time, when I was part of the GST implementation, when we were talking with the GSTN on that time also. So that time, the mandate was very clear to GSTN that we will require, the government will require, whether the state government or central government will require a lot of information lot of reports now. Now, this is normal reports. You might be thinking that people who have not filed the GSTR1, who have not filed the GSTR3B, or who have not filed one of them, some mismatching. No. Beyond that certain information, I'll just want to give one or two examples. What department has, and they are using it. Very important. DGGI, almost all of you must be knowing now that. Now, the information about the classification, that's the HSN code for the purchases, is not being entered in any of the return. It was supposed to be, I remember, part of GST 9C or 9 somewhere. Somewhere it was supposed to be there, which the government has, I think, put in the hibernation.
In the option, yes, in the option.
In the hibernation also. But department is still capturing this information. They're getting the information from where? E-way bill. E-way bill. Before e-invoicing also, e-way bill, the sender is capturing the HSN code for all the goods we're sending. So the department is capturing even your purchase, because all your purchase comes in GSTR 2A, supported by e-way bill, just linked with that, because the data mining and warehousing is so strong now. So department is capturing your purchase invoice classification, matching with your sales, and specifically in the case of traders. Of course, in the case of manufacturer, this problem will not arise, because naturally your classification for the purchase and sales is 80, 90, 99% will be different. But for the trader, it has to be same. The department has booked the cases based upon the case of traders. You purchase mustard oil, you are selling, some other oil. It's live cases. Which was booked in Ahmedabad, in Gujarat also. I can give many examples. Time is not for that. So what I want to highlight here is that the quantum of data and quality of analysis and the tools available with the department, as Rakeshji was also saying it now. Perhaps this first time, the industry is realizing that they are maybe some industry may be, less not in the catching with what the department is doing, which is a matter of fact. Because all the cases of your fake invoices, which we keep reading in the newspaper every second day, some of other cases getting booked, is simply and simply based upon data analytics. I can say you with confidence, 99.9% cases and no informer. Earlier, such cases were booked based upon some information, some rivalry. Now you don't require an informer or rivals for that. It's a data study. One person and not filed the return, either A of GSTR 1 or 3B, then how does his goods and move to B to C, C to D, D to E? Everything is captured through the system. So I'm ending my general talk here now. And now coming to specific question, what Sanjay has asked is that now, is there going to be change in risk parameter for selection of units, taxpayers for the scrutiny and the audits now? Yes. The earlier risk parameter generally were what we used to call R1, that's a PLA SANVAT ratio. Wherever the maximum payment was made through the SANVAT credit, that was one of the major consideration. And of course, that time we had put one more parameter within the industry framework, like RECs with manufacturing, electrical, what transmission light or whatever they're making, about in manufacturing, this, say pharmaceutical industry, what should be generally the SANVAT ratio. R1, R2, was one of the factors for selecting units for audit in the past pre-GST. Another was high duty pay revenue, and sometimes theme-based. These were 3, 4 were the only criteria which we were using it, department was using it for the selecting now. Now look at the database now. Now, of course, the PL cash and the ITC availment is going to be one of the important criteria. Now, second criteria, exempted and non-taxable turnover as versus the total turnover ratio. What is going to be there? Third, as I mentioned, you mismatch in the case of traders about the classification of input and output. Of course, fourth is, all of you know, the fake invoices, transaction, and this thing. Another important, not from the audit point of view, even with the same mobile number and same email ID, how many registrations are there? That information is coming regularly to the investigation wings of the commissionerate and to the DGGI also. This is all, again, not from audit point of view, because since I'm talking here, this will be applicable for the cases picked up for investigation also. Right. But with all the database now, the cases will be picked up. Some cases will be given for scrutiny. Now the scrutiny, I think section 65 or something is there. And then we got audit 66, 67. I don't recollect number exactly. Right. And then, of course, investigation are there. So scrutiny will be started a little later because till now the departmental officer, to my understanding, were busy in the pre-GST, that excise and service tax audit, 2016 being the last now, 2021 5-year period getting. But now they will start the audits, GST audit in full-fledged way. Some of the cases may be picked up for scrutiny also. There's a power has been given. So I still think that they want to continue with the scrutiny for few people where they don't want to go for full-fledged audit. So certain criteria will be picked up for a scrutiny, then for audit, and then investigation. Another important thing which is going to happen, and which we understand with my old colleagues, we keep talking in the department also, the theme-based audit. Suppose they file the 17.5C and D, credit on the construction-related credits have been taken from to a particular industry. The simplest and obvious example, telecom tower, for example, that all of us know. Telecom tower, credit on telecom tower taken by telecom company. Leave apart, that's very obvious. But still, 17.5C and D is one area, it can be theme-based study. There can be a, if the department finds there is a particular misuse of a particular exemption notification, then all the people availing that benefit might be picked up. So it's a theme-based audit, is a new concept is going to be started in the department, which were earlier used by C and AG. So that's another thing only. So I think that is all I want to say about the new system of the methods for selecting of the unit as I covered.
Right, sir. I think, right. Thanks a lot for a lot of insiders. In fact, this helps a lot to know that the department is thinking far beyond at least the way we have going through, and the way you rightly pointed out that they have already started concluding the erstwhile regime audits, and they have already started picking up and identifying the assessments they want to pick up, or at least start assessing the SSC to see if they've actually done any issues or something like that. But during our GST days, when the GST came in, we started realizing that the number of audit team has now increased. It was initially that VAT stream was doing one audit, and then maybe service tax was doing something else, and excise was doing something else. All three of them are now a troop. In fact, it's like the number of people have increased, and therefore the number of audit percentage or the assessing, would increase twofold or threefold the way it was happening earlier, in the service tax or excise regime. Hopefully, we are going to see that pretty soon because the assessments have started opening and slowly everybody started getting notices. With this self-certification coming in, is this scrutiny going to again increase further? Is that the thought which is coming in? Or is there, say for an example, today we are doing the 20-25% of a scrutiny. Tomorrow, since due to self-certification, will this 25% say increase to 40% or 50%? How is the department going to foresee at least in the increase in number of scrutiny from 9(9)C perspective? Sir?
See the point. Let us see this first the fact and then the practice now. Fact is that as far as central government is concerned, the number of audit commissionerates, I think, have remained more or less same. This was not a very big changes. Some places might have increased by maybe something. As far as state government is concerned, there, as all of us know very well, the assessment was done in the office, and whatever word we use, they used to call the taxpayer to the office and see the records. And in the new system now, their state government is also going to switch over to the SSC premises based audit now. So, to my understanding, the number of taxpayer to be selected for the audit will not increase to a in a big way. There might be slight changes, slight increase, but not the big way, because the number of officers are going to remain more or less same. Rather, in the case of state government, I think the number may go down rather, because earlier, every officer, CTO, I don't know what designation they were using, commercial tax officer or sale tax officer or whatever the name they were using. Most of them are doing the assessment now. There also, this will go down now. So there also audit, the number of people working in the audit section in the state government will also go down. The first fear is that it will increase. My personal understanding that it should not increase, because ultimately number of units to be picked up for the audit is depending upon a number of resources available, how many people are available. So that number has not come, so it should not go up. That's the first fact. But this audit, of course, is detailed. sort of assessment, basically. But a scrutiny thing, I don't know how what shape is going to take. And for the scrutiny purpose, every state government is free to devise its own ways and means and how many people to be, records to be scrutinized. That's only a very little, it's a big gray area. And there, if the discretion is not used properly, it can create a lot of problems. Because simply I send a letter that this company has been picked up for a scrutiny, please send us the information. And then you are gone now. When the scrutiny is going to be completed, God knows only. Because audit, we know at least people are coming to premises 10 days, 15 days, 30 days, maybe 1 month also, some big companies also. But after that, since they have to pick up new audit, so they have to leave that premise and go to second. So at least there's some end is there. In the case of scrutiny, you simply send a mail and send this information. And again, old practice of calling back the taxpayer to the office may start. That's a really big worry, and that as an association from CII and all the people, we must take up with the government that in the guise of scrutiny, they should not, start a new way of, calling for record and calling the people to the offices, and the whole purpose get defeated. Right. So that is my thinking on this, that, numbers should not increase, but yes, quality will increase definitely because the type of information they got. One more thing, as I missed in first part of my discussion now, this people who are going to be audited, this is selected now by a unit called ARM, Director General of Analytics and Risk Management. That's it in Delhi now. And of course, they work along with the Director General of Audit, DG Audit, the two directors are concerned. So based upon various analysis that I was discussing, they pick up here the high risk is there, moderate risk is there. So they prepared the list for each commissionerate audit and send to the respective commissionerate. There they select big units, medium and small units also. But there the discretion is given to the local commissionerate. You can pick up based upon your thinking now. And they are also allowed to add some 15-20% new people based upon the local parameters also. So this is the method they follow, and this method I think is a more scientific. But important point what I want to know that when they select a unit, like in the case of income tax, the reason for the scrutiny is given. And in the case of income tax, I think to my understanding that income tax officer cannot go beyond that reason. Whatever has been given for the limited scrutiny, whatever you call it now. So this is the thought process is going on. And I think as an association, we should request the government, let us start the same system. You have a particular reason to pick up a taxpayer for the purpose of audit or investigation. Limit your things to that level only. Suppose your limited purpose is your ITC utilization is very high as compared to the other people. No problem. You do entire scrutiny, but don't pick up other issue. In the name of ITC, you pick up classification, you pick up valuation, you pick up so many things also. So this association can take it now. But this reason is coming as a part of the list which is sent by the DGAR. So normally the officer is supposed to look into that, but since there are no guidelines, they are going for other areas. So that was the point I think I want to say.
Right. Thanks for the insight, sir. In fact, it was a lot of helpful and seemed a little scary also, to at least look at, the stuff and how the things are going to be there. In fact, I've been looking at it from the theme based, the way you spoke about that different themes are being followed by different people. And in fact, say DGGI picks up, say only credit based, investigation, and DCCI comes in and he says that, okay, your output liability is not verified. Can I look at it? And so credit for RCM was not taken up. So can I actually look at that? Maybe the GST auditor is picking up a lot of stuff on reconciliation and things like that. So there are 4 people who are at least trying and auditing the same period, same SEC, same timeline, maybe just to have a second eye view. And there are some places, I think even the external chart accountants are getting hired. So I do understand that the scrutiny is going to go more deeper and more specific to how things are getting in, and maybe it can also take a color of investigation. So this brings me to the question, Rakesh ji, maybe do you want to throw light, how is the authorized signatory safeguarded, with all what we heard from Sushil sir, how is the life of an authorized signatory going to be safeguarded after this?
So Sanjay, just to first means like very insightful thoughts from Sushil ji. And and this is what sitting in the industry we are realizing actually. If you look at that past few months or few quarters, more and more emphasis is on the theme-based audit, where or some information-based audit, or information based on some data analytics actually. So you seem that days are gone when there used to be a general audit. They used to ask for the entire information, trial balance, purchase information, sales information, all reconciliations. So we are yet to see those kind of audit. I'm not saying that will not happen. That may also happen in time to come. But I think at present, the way these audits are getting conducted actually, these are more and more on the larger issue, which is industry level issues, okay? Not on the individual assessee or entity level issues. We have seen that investigations are taken based on the investigation on some other organizations also. Like we have seen that the whole menace of this fake invoicing. Right. So not only the person who are issuing the fake invoicing, but all the persons, all the entities who are transacting with those entities also, they also was covered, and their transaction was also got scrutinized actually. Right. So I think this bring more and more cautious approach at the organization level also, that entity with whom I'm dealing. So I need not to be whatever the transaction which I am doing actually, but I need to be very cautious about the person with whom I am dealing actually. So I think that is a whole the responsibility and obligation on the organization is huge actually. We don't know that what kind of compliance level, what kind of system processes which are being followed by your vendors, your customers. Other thing is that, like, whenever you go for any kind of refund, you ask for the refund of inverted duty, you ask for the refund of exports, at that point of time also a lot of data is being scrutinized. So it is not a simple process as on date. And wherever they feel that you have taken credit for some party which is already under investigation for some region, your things are bound to get delayed actually. So these are the thoughts what I wanted to supplement what Sushil has said. Thanks. Coming back on that your specific question on how the signatories are safeguarded actually. I don't know what kind of safeguard can be ensured. Okay, and earlier also means like signatory used to certify, auditors was definitely sharing that responsibility. At least signatory had some comfort that whatever the document is being signed, it is also has been scrutinized. It is also has been checked, audited. So there was more comfort in signing those documents. Now with the self-certification and the way language of the self-certification onus is really very high, and the person who may be signing has to rely on the operating team, that entire process system. So generally in the corporate, we have a kind of certificate where a functional lead will give the certificate, which is generally placed before audit committee also, that all the system, all the processes, all the law, all the procedures has been followed. There is a proper SOPs kind of thing. All compliances are properly done. Okay, and there is no intentional defaults actually. One can't say that there is 100% compliance. There may be some issues. There may be unintentional errors in the system. But at least while signing the document, when the CFO or MD sign the document, functional lead will also support that with their own certificate that all compliances in their particular area has been properly taken care of. And one is that, and second, I think though this self-certification is there is still an external audit being done. There are internal auditors who are involved into looking at the compliances, any issues actually. Still, people may like to though it may not be signed by them, but still may like to continue with the audit requirement. They may continue to follow the same process which has been followed pre 2021 or 20 and get it confirmed. If your auditor will not sign it, but they will confirm that we have checked and all the information are in true and fair actually, or proper,
right,
for internal satisfaction or internal reports.
Right. Thanks, Rakesh. So generally, what at least we've seen is that the company or the directors take an indemnity from the company itself, that okay, their personal liability is safeguarded, so that nothing actually comes to their personal level, at least from the liability which comes in. But yeah, I do understand there's a lot of safeguarding which is required for the authorized signatory. So this gets me, maybe we will try and understand if Sushil also has some inputs, that, sir, is there any action that is going to be taken against the authorized signatory for misstatement? Any precaution that they need to take? Any inputs from that side?
See, the point here is that it's a question of culpability, basically. Suppose something is done, something is found by department, where it is found that it is something, what is suppression or the intentional lapses, or he was a party to something. In normal case of audit, suppose tomorrow somebody's department finds that some credit has been taken wrongly. I'm not talking about a fake and bogus invoices. There's an interpretation, 17.5 and C and D, or something food item you've taken, or even the classification, there can be dispute. I mean, you might have paid 5%, department say, no, you're 18% only now. Like the valuation cases, somebody not paid tax on the interest amount. So there, I mean, there is no such thing like, he has done intentionally, basically. But yes, so as far as audit is concerned, generally this certification not going to put anybody in the problem. But there can be interpretation issue. Even today, the departmental, courts keep changing their views. So one point. But yes, if there are certain issue where there's a culpability, basically fake invoices, there, the investigation team, not the audit team, basically, or an audit team, they may ask the question, what basis you're certified that all the information given is correct? When I say information given is correct, means you have received the particular raw material goods, and that's why you're taking the credits. How did you ensure it? So there's the question what Rakesh has also pointed that what should be the precaution can be taken now? So this question linked with that only.
Yeah.
So, I mean, of course, there is audit committee in the big company and everything happens there. We have suggested to whoever the corporate clients are there only that because the person who's going to sign this particular certificate, he's going to authorize signatory or somebody sitting in the head office. Factory somewhere else. About India, the head office in Bombay, factories 1, 2, 3, 4, 5 places in the state, for example, now. Okay. So in that case, as a person who's signing, he should develop a SOP whereby the people who are purchasing the goods and who are taking the credit at the factory level, for example, they should give a certificate. Yes, we take the credit because these goods have been received and thereafter we have taken the credit. Wherever such issues are there should be some system whereby on a monthly basis, before filing of return or along with filing of return, there's some certification by the people who are on the job or on the spot. So that can absorb. Tomorrow, department, even if that fellow might have left the job, but since he signed the document, the officer can call him. What basis did you do? So you will say, sir, I was getting a certificate. What else I can do beyond that? I mean, I cannot go to the factory and find out whatever happened there.
Right.
This sort of SOP, but there should not be too much of fear in the mind of people who are signing this, because here is authorized signatory, somebody files the income returns, somebody files other returns also. Even though your GSTR1 and GSTR3 be signed, somebody signing it also. That does not mean that he should be too much afraid that too much responsibility has come upon him. The only new responsibility which I feel as compared to GSTR1 and 3B is that reconciliation only. So in the case of reconciliation, I think Prabhatji or Rakeshji, somebody raised this point that take the TB and from the TB ledger account wise, that has to be seen very crucially, because we have seen the cases, the department has found out some of the income heads have been adjusted against the expenditure heads. No, I mean, that will not be visible on the seeing of it. Those sort of things, somebody has to be a little careful, or the consolidation people has to be careful. That's what I will say. Otherwise, no need to worry much, because simply signing somebody will go and, catch you and, nothing will happen.
Right. Right. So you also raised a very valid point that, there are like factories located across the state and maybe in the country. And yeah, so all these factories or maybe locations generally are registered and having GST numbers. And these also used to get audited. With the CA fraternity, we were able to spread across all India level and at least get this certified and maybe at least do that. So this brings me to the question, Prabhatji. I do understand you have 24 different registrations across India and handling this through a self-certification basis. How are you maybe looking at handling this specifically? And I do understand that you've automated a lot of processes and you mentioned this, but since it is going to be like an across India level, anything that maybe you've equipped yourself, I don't know, looking at how do you want to handle from a planning perspective?
Yeah. So first of all, many thanks to Sushilji for putting out the all the aspects very clearly. That helps us to understand what could be the thinking process from the department side. And I'm sure many people would be benefited out of that.
Right.
So I agree to Rakeshji and Sushilji both. I think they have put it very precisely what the approach should be. So you are having the 5 location or 24 locations, probably it doesn't make much of the difference. So far you have the right processes in place. Right. What is important, first of all, let me put it this way, that we have got 2 sets of audit. So one is to be called as a general audit and second is to be called as a special audit. What is important is to understand the timeline. So in general audit, the initial time period which is permitted to conclude the audit is 3 months. Also in case of a special audit, wherein a chartered accountant can be hired by the department to do that issue-based kind of an investigation and get into more details of the audit side, there also the time period is 3 months. Of course, that can be extended, but the initial time period is 3 months. Considering that, what is important that what kind of an automation you can put into the place, so that assuming if you are handling 5 or 10 locations of the audit at the similar time, how you are going to manage. If you are managing from say central or head office per se, your team is going to be one. If they are equipped, and let me put it this way, that every state may not be having the similar complications, the similar kind of activities. So you need to have an understanding and put your designated people rightly in place, that who is going to handle which kind of a state and what kind of capabilities you want to create to handle that state. Because assuming, say, being an HO in Maharashtra, we may have more complications than having merely a CFA location at some of the state. So that's how you need to figure out how you are designating your people to handle those kind of complications. That is one. Second is that I always believe and feel that for handling this GST audit, we need to ensure that we have at least one person designated who have the controls for entire India per se, at the PAN level per se, I would say. Because it should not so happen that you are intimating one set of data or maybe one particular way of representation on or any particular tax position you are taking in some state is different than what you are taking in the other state. Probably I go back to the statement of Sushilji and somehow to the Rakeshji also. We all know that industry is now catching up. The situation is completely reversed. The data point and the data analytics, the way government has as on date, which was never been the history, it's completely different industry, I would say, is now catching up. It's not, so government is ahead, no doubt about it. So we all are gearing up, we all are putting our processes in place. So it is important that you set up the right set of automations so that you have the information, not only the information, the critical information, the analytics of it, so that you can take the decisions basis whatever the data point you have in a short period of time. So it is important that you designate the right set of people with the right set of automations. That is going to be the key in handling the across locations, states audits.
All right. All right. So this brings me to again the next question, which I think I have personally seen the way I think the way department was handling it, that they had a lot of AI tools developed inside, and I think the way Sushilji also mentioned about this specifically, that there are a lot of tools that they've developed, and there is a way the data capturing actually happens today, and the data mining is actually happening. So Sushilji, any AI tools that is going to be developed from the assessment perspective, anything from this sort?
See, I think very frankly, we all of us heard about AI and machine learning.
Yeah.
I was about to go for one lecture, and for the CWA. So they give me a topic of this. So that's the time I talk to the people who are developing the system. I talk to even the CBI people, police people also. They all our own my colleagues only.
Right.
Very frankly, if I do very technically, there are no AI tools is presently used. And I don't know future what they have it. But AI tool is something where the predictions happens and everything. Yeah. But today they have the analytical tools, very frankly. Not the, I mean, it's a very highly technical answer, basically. Yes or no, I'm just saying you. They don't use AI tools. This is only a data analytics, but very excellent. But the question about your question is something that, when they say whatever technique they use it, is the quality of the audit is going to be improved because of the use. Well, one is the data analytics at the apex level for selecting of units and finding who is not doing, who is tentatively not doing right thing. And perhaps your question, Sanjay, is that at a real audit happening, is there any tool is going to be used? That's, I think, your question now. I'll just tell you because there's some type of audit, what we named in the department is a CAAP, Computer Assisted Audit Program. This was the name given for the audit now. And there, what happens, because I was the first person to learn this audit. We had gone to Canada at that time from the government of India. And we learned this almost 1 month, very rigorous training we were given. We thought we are going for holiday in Canada. So we'll do masti karenge, government pe ja rahe hain. So, but this was really rigorous training.
Right.
And when we came back, they taught us to use this a software called WinIdea, this IDEA software, which was developed by Institute of Chartered Accountant in Canada, and it became very popular. This was used in the USA also. Of course, now that has been sold to some Singapore company. Crux of the thing is that, yes, department is also using, like in a statutory audit, people use all this various type of a audit software.
Right.
So this is also one type of audit software which the department is using it. Department, when I say from excise custom, I mean, not the state government has not learned it. And it was supposed to be used by income tax. But fortunately or unfortunately for somebody, the income tax people did not, push it up, basically. It is being used in the erstwhile excise and service tax, and now in the GST department also. So what they do, they take the entire raw data from the taxpayers, upload in their WinIdea software. There again, because the analytical tool is so beautiful, basically, like, I mean, simple, other day we were talking about the duplication of credit. On one same invoice, you've taken double credit. This is very simple. But otherwise, you create a virtual field and match the data, purchase date, 6-month payment, happen, not happen, all the things on one item, how much, credit you have taken, what's the trend of taking the credit. So it shows some abnormality. This tool is excellent. I will say not tool, is a software, basically. So yes, department in selective cases is using this particular software. Department is a central government only for the purpose of audit now. So yes, I mean, this is the new thing, and department, the plan of the government is to expand this particular way of audit in a big way, because as we know, whether you come to KSC or Abbott or XYZ, big companies, it's impossible for a government officer, tax auditor, to look into data, physically. So this is the only way. So they are also catching up on this line also. That's what.
Right. Yeah. In fact, I have also been a party. Maybe I had this opportunity to at least be there on an investigation where such kind of a tool was used. And for my surprise, the department never asked me any documentation. They said only give me soft copies of your Excel file, transfer, your extract of your whatever ERP you're using from accounting perspective. Just give this to me. And they ran that on their system. And I think, they started identifying, like I told you, during our conversation earlier, that, they were able to identify all the credit issues in the past years, in the current year. Capital goes just like example, in the earlier regime, 50% you take earlier and 50% you take later. So they were also able to identify that, have you taken this double credit? Have you taken single credit? I think very minuscule numbers with all the detail. And it was, I think, a fantastic thing to at least vouch for and look at that, okay, the way the department equips. So yeah, I can understand what you're saying, sir. And the CAAP, I do understand is also a way of at least, the way department is moving forward with their automation perspective. So yeah. Maybe a couple of questions. Last, maybe because we've just come to the timeline to close. Maybe I will just try and ask Rakesh ji, do you see or recommend that the company should at least get their returns reviewed just to safeguard themselves or the risk that they are carrying due to self-certification? Because I've seen a lot of industry taking this up specifically on their own. They are saying that even though there is no certification, at least I want the CA to continue what he was doing. It gives me a level of at least confidence that okay, whatever I'm signing is at least verified and looked at it from their perspective. What's your views?
Yeah, so like before coming to that, one thing I forgot means like I heard Sushilji saying that now government has a specific DG office for data analysis. I think right, Sushilji, I heard that right thing.
Yeah.
I don't know. Like it's a news for me. I don't know any corporate have any specific department for the data analytics. So this is the change, Sanjay. Means like for all my colleagues who are on this.
Rakesh, can I take 1 minute? If you give me half a minute only, Sanjay, if you allow me.
Yeah.
This DGARM, I mean, just if they're giving out of GST now for just audience benefit only. All of you might have heard one case of this narcotics seizure in Mundra. The 2 containers have been found full of narcotics. I don't know whether you noticed this news or not. Basically, it's happened about 2 to 3 months ago, basically. Yes. And then it got too much of publicity as against Shahrukh Khan's son or whatever. That they say for 2 grams you are making so much of noise, whereas there was a containers. I mean, which was around, can you believe, 15 to 20,000 crore value was the.
Recently in Gujarat, I think that happened.
Mundra mein tha, Mundra mein tha, Gujarat mein tha. But you know from where it was got it now? DGARM. DGARM, they got one unit called NCTC, National. Ek second, which I'm just NTC, National something. I'm forgetting the full pronunciation for that only. So this unit is again a part of data analytics. So they keep doing the analysis, and this case was booked in Bombay by few people sitting in the office only, no informer. What they found, first thing, goods were loaded from Iran. Okay, goods were originated from Afghanistan. Item declared was talcum powder. Okay, importer who was importing from Mundra port, he was from Andhra Pradesh or Telangana, somewhere, I don't know exactly, somewhere. And so they had some doubt, and this fellow had no history of this thing. The person who was importing, he has taken a very recent IEC number, import-export code number, no earlier history of this thing. Put together everything, there's 2 boys sitting in Bombay, in Marine Lines, in the Marine Lines, backside they got an office here, in DRA office, they just sent through their own sources in Hyderabad, just find out who this guy is there, scatter check karke aao. They're found to be bogus. This information, but there are hundreds of document comes, hundreds of party importing. Out of that, catch this one. This is sheer data analytics. That's why I'm telling you, aapne bataya ki there's their office. Yes, there is an office. They do a lot of jobs. They do it only. So based upon data analytics, they were able to catch a fellow of narcotics import. Can you believe? I mean, so गवर्नमेंट में काम हो रहा है सर आजकल. पहले लोग सोचते हैं गवर्नमेंट में काम नहीं होता था, बट ऐसे ही नहीं कहता, बट
सब काम गवर्नमेंट में ही हो रहा है, मेरे को लग रहा है, और बाकी सबको काम पे लगा रखा है.
Sorry for the interruption. Only I thought I'll just change the. Yes, Rakesh ji was saying something.
No, good. Thank you, Sushil ji. I think this was very informative.
Rakesh ji, sorry to interrupt. Sushil ji has put everybody on high alert, not only on alert.
So we were on the alert, not on high alert. No.
High alert.
If we improve the system, is good for everybody. I mean, I'm not threatening to anybody, but we should know what's happening. That's all.
True, sir.
We will become a little more careful, all of us.
No, I think Sushil ji, sitting in the corporate, we know this is only a beginning actually. Okay, lot more to come and lot more to be faced actually. Okay. And unfortunately, last 3-4 years, the GST law was not very stabilized actually. A lot of processes was not stabilized, and only I can hope that unintentional errors and bona fide mistakes will not be taken very strictly, and some liberal view will be taken by the government, subject to there is there is no intentional or there is no modified transaction actually. So having said that, I think things are much complicated now. Okay, and the way that government is working, I think corporate needs to catch up, and that's why I was saying that it's a news for me that there's a separate department for data analytics, or I don't think any corporate will have this kind of department in any organization. So coming back to the question which Sanjay asked about continuation of the review process, I think, Sanjay, my answer to that is, I think it is more needed now. Actually.
Right.
So earlier when you had an audit, actually, I think the onus was shared.
Right.
Once this certification is there, I think it is, the requirement is not, it has only increased.
Right. Right.
I think it will be because in your day-to-day operation, and with a limited kind of resource, limited kind of time, what kind of bandwidth you have in your function, okay, a lot of things go unnoticed.
Right.
It may not be intentional, but a lot of things we keep on doing the things, and we presume that whatever things are going with is right actually. And
right.
GST is not like that only tax department or tax function is controlling that. Right. Entire purchase function is involved, the sales function is involved, logistic right. function is involved, export function is involved actually. Okay. So entire organization is involved in the transaction.
Right. Right.
And I don't know, means like how many control, how many system, how many processes you can put, which is so it will always be better to have these reviews done before the information is filed. And this is a time when any error which has happened, okay, any unintentional things has happened actually, those can be corrected. So
right.
I think that recommendation, or in fact what as an organization we have decided to continue with that, and I think it will be more rigorous now. Earlier it may right. not be as rigorous as it is now.
Right, right, right. So Prabhatji, are you also aligned with Rakesh's view? Any thoughts that you have?
No, I think simply I completely agree to Rakeshji. I think we also have continued, and I think this is what the recommendation should be. You should analyze where at least one has to analyze, if at all he has got the presence, say in 5 states, he has to analyze which all states have got the complications. At least in those states where you have the complicated transactions, you have some kind of, not the routine transactions coming in, you should always have it. And if at all possible, I think it's recommended to have it across. Right. So as an organization, we also have done it. Let me put it, another aspect to it, and just capitalizing on what Rakeshji touched upon, that GST is not only the aspect of the tax. So tax is, as we all know, it's a reflection of the business action. Okay. So it's important that we collaborate with each other across the functions. So that is more important. I'm not sure if the organizations can create a separate vertical, which is having the intelligence, to look into the data set of all that. But I believe at least what we can do is the collaborative approach putting into place, wherein we can create a core committee, something like that, which can meet up maybe every quarter or something to decide upon these are the transactions, this is what has been done, etc., and how to take it forward. So that at least all the business functions are coming together, including if there is an automation requirement, you have your IT person also in place, IT heads also to be part of it. Because it's not that if the IT guy is not aware about what is the moot requirement, probably he will lapse in developing that, and it will take more time than what is expected. So we all need everything quick. Is something like that. It was all expected yesterday, nothing tomorrow.
Right. Right.
From that perspective, it is important that we collaborate with each other so that we can achieve the timeline and the desired results in timely manner. That is more important. So I think I'm also of the view that we should continue.
Right. Thank you. Sushil sir, you also feel the same, and any leniency that you're going to show towards these, at least, the industry and maybe the CA, because they would be doing the self-certification for the first time. I think non-compliances or any, smaller things which go unchecked, would there be anything from that side? And do you also feel that, okay, they should get it vetted, because the preliminary vetting is going to be at least get all these hiccups, addressed at the first level itself, rather than coming to you at a very large scale. So do you think the same way?
one point I think I totally agree with Prabhatji and Rakeshji. But question is that this answer can't be the straight jacket answer. It depends upon that your quality of internal controls you have it. In that nobody can say, only senior management can find from their own experience how much confidence they got it in their team. But especially as Prabhatji has mentioned, if the certain, suppose you got different factories, different places where you think little internal control may not be so strong, or suppose the complex transactions have taken place, you should go with that also. You should go for the professional audits. But one important aspect is it's a human psychology. What I've noticed, dealing with the clients with us, normally if any person unintentionally, even he commits some mistake, he has not paid. That's very common thing. He has not paid on RCM. Some import ka ho gaya, bhul gaya. It happens. And generally, when the whole, at the end of the year, 99C comes, even if some boards come to mind, chhod do yaar, white wale pakde dekha jayega usko. So human psychology for any person who is dealing day-to-day work, who is doing it, he of his own, perhaps he would not like to expose himself. This, I've done a mistake. So in that context, the external audit, since he's being an independent person, would be a good idea. But yes, it can be checked every year. Suppose 1 year audit, 1 year, that verification done, and companies find that 99% my work is okay, then you can take a call next year to do or not, or maybe every alternate year can do it. So, I will go for that. And second question was that being a first year of audit certification, whether department will take it little, lightly. Sanjay, the question here is that you have first year of certification or after 10 years, that does not make a difference. The whole question is that you have this, that extended period, a suppression of fraud, etc., etc., etc. If it is not there, then law itself provides, if it come to know of the revenue you pay with interest, matter gets closed. Even within 30 days of issue of show cause notice, if somebody pays the differential tax and the interest, matter gets closed. Afterward, whatever the some facility has been given. So I think the aspect about being first year of certification, somebody take lenient, doesn't take lenient, is not, I think, not very, I will say, not required, basically, not relevant also, very frankly.
Right. Agreed, sir. In fact, yeah, thanks for all your inputs. Thanks, Bharatji, thanks, Rakeshji, and thanks, Sushilji. Maybe I'll just conclude the remarks here specifically that with the, at least automation coming in, and that's insight which actually Sushilji has given, it actually brings us to the conclusion that there has to be some automated, tools, at least, at your end, which actually picks you and gives you that edge over at least, analyzing your data at the first level itself, so that it actually is verified and vetted, and then it moves on from there. In the audience, maybe if there is anybody who has questions, you can pose in Q&A, before I actually conclude. Basically, while withdrawing of certification, it's a welcome change for very small taxpayers, as it takes away the need of reaching out to a CA for certification or maybe reconciliation as such specifically. However, insofar as all the medium-sized or large taxpayers are concerned, even if they are not getting themselves certified or the CA certification being done, the complexity of the transaction, the rigor of the tax authority, with the AI being introduced, just to understand if there is any wrong thing which is there, our validation or the new law, and GST being so robust, every moment we see that there's going to be a change, and every month at least we do see a lot of changes coming through, and therefore with that rigor, complying with this law is necessary that we have some review from the third party expert, or maybe at least do a review at your end, so that through an AI technical based tool, so that it actually captures and safeguards you from any personal liability or any inadvertent error or misdeclaration that actually happens, and which will at least help you from any interest or penal liability. So overall, having some SOPs which actually gives you that edge of that, okay, there are, you take care of your ITC bifurcations, you do matching of your additional liabilities, correct filing of DRC 034 periodicity of something, or maybe HSN summaries. This was also an insider which at least Sir gave us, is that your HSNs need to be validated. So this is an overall bringing, and therefore I think while self-certification is a welcome move, it raises an alarm at the industry, and that, okay, they should at least start building their SOPs at their end, and maybe looking at how exactly the risk mitigation actually takes place. So thank you. That's it from me. I don't see any questions. So Vinitji, do we conclude it? And Naina, you're on mute.
Vinit sir had to leave for a meeting. So I would like to thank Mr. Chabri and all our panelists for their presence today and also their valuable remarks. Thank you very much. And I would like to tell the participants, tomorrow we have the entire, the half day on global or cross-border taxation. So I'm requesting all of you to join for that as well. And if you have some colleagues who may be interested in this subject, you may also share the links with them so they can very well register and join tomorrow.
Yeah.
Thank you very much.
Thanks, Naina. Sorry for extending the
Absolutely
session
fine.
by
No
10
issues.
minutes. Yeah.
No
Thank
issues.
you. Thanks a lot.
Thank you. Thank you.
Thank you.
Thanks. Bye.